Very good morning, everyone. Hope you all must be doing great. I will not ask you how was your accounts paper and your law paper. Some of you might have done it really well. Some of you might not have done it well. That's completely fine. Now forget about whatever has happened. Now you have to concentrate on your next paper, income tax and GST. Right. Today I'll be revising the income tax portion with you. So it would be, although it would be a quick revision, but I would be concentrating on concepts also, so that all your concepts, whatever you have done till now, it should be revised within next 5 to 6 hours, right? So let us start with our chart book revision. This chart book is easily available. The link is in the description. You can easily download the chart book also. I think that you must be having it. In case you don't have it, you can easily download it from the website. The link is in the description. Okay, so first I'm starting with the basic concepts. Here, you should know what about the tax rate. You should be very well through about the tax rate. You should know about the rebate. You should know about the surcharge also, right? So basic concepts. We understand that there are two regimes: optional regime and default regime. Default regime under 115 BAC. So first, if the question is always silent, please apply your default regime. And mostly now, if you look at the trend, mostly the institute is asking more of a default regime questions only. But still, we should know what are the tax rate under optional regime also. So if the assessee is individual HUF, AOP, BY, or artificial juridical person. See, mostly for our examinations, the most important assessee is individual assessee, right? So if the person is individual HUF, etc., then the tax rate would be as follows. First of all, whenever you have to apply tax rate on your total income, see, whenever you will be applying the tax rate on your total income. So let's say your total income is, for example, 25 lakh. And now the question is asking you to apply the tax rates, correct? So please, first of all, ascertain whether it has any special income or not. We have special income like long-term capital gain, which is taxable at 20%. We have triple 1A, short-term capital gain. All short-term capital gain, no. Only on equity shares or equity-oriented units, 15%. We have triple 1A 15%. We have 112A 10% in excess of 1 lakh. Then we have casual income 30%. Very rarely they will give you unexplained income or unexplained expenditure where the tax rate is 60%. These all are special income. I'm repeating myself once again. See, first of all, you have to calculate whether we have our special income or not. So income could be long-term capital gain. So long-term capital gain are taxable at rate of 20%. It is a special income. So if your total income 25 lakh as any long-term capital gain, please charge 20% tax on that. Correct? If the assessee has short-term capital gain also, which short-term? Specifically triple 1A, which is, what is triple 1A? Equity shares or equity oriented units. More importantly, equity shares. So that is equity shares or equity oriented units, mainly equity shares at rate of 15%. Whether all short term is taxable at 15%? No. Only equity shares or equity oriented units which are sold on stock exchange where STT is charged, that is taxable at a rate of 15%. Then another special income we have a long term capital gain again, but a very, very specific long term capital gain, equity shares or equity oriented units sold on stock exchange. Equity shares or equity oriented units, here the tax rate is 10%. Now, please don't make a mistake over there. You understand? Because students will remember that on 112A, the tax rate is 10%. But please also remember, it is in excess of 1 lakh. It is in excess of 1 lakh. In excess of rupees 1 lakh. So let's say if you have 112A income, this is 112A income, let's say 5 lakh rupees. So don't apply 10% on 5 lakh. No, in excess of 1 lakh, it would be 5 minus 1, 4 lakh. There you have to apply 10% rate. Got it? Next, if you have casual income, lottery income, game show income, online gaming income. So casual income has a tax rate at 30%. So mostly these are the special income. Very rarely if they will give you, that is unexplained income. On unexplained income, we have the tax rate at 60%. Got it? So these are our special income. So first of all, let's say if you have 25 lakh total income and whenever you have to calculate tax, First of all, always determine, just pause a little for 5 seconds and just see whether you have any of these special income or not, right? So let's say if you have 2 lakh over here, 3 lakh over here, 4 lakh over here, let's say here it is 0, here it is 0. So 2 plus 3, 5 plus 4, 9. If these have, also include them also as well. Then just subtract all of these from 25 lakh. You will get the balancing figure. That is called normal income. So normal income, that is called, you can say balance income, you can say remaining income, you can say normal income also. On normal income, you have to apply slab rates. Correct? Here you have to apply slab rates. Now, what are the slab rates? See, if your assessee is following either default regime or they have opted out from it, if they are following optional regime also. So on this special income, it would be same. So LTCG 20% is same in default regime also, in optional regime also. Everything will remain same. Only the changes here. Correct? The only the changes here. So if your assessee is following default regime, then you understand the slab rates are, it's very easy. There is a 3 lakh, 3 lakh, 3 lakh difference, right? So first 3 lakh, it would be nil. Next 3 lakh, it would be 5%. Next 3 lakh, it would be 10%. So here is a gap of 3 lakh each, and here is a gap of 5%, right? So once it reaches 12 to 15 lakh, it is 20%. After that, above 15 lakh, it is 30%. Got it? So if the assessee is following default regime, we have the slab rates. Irrespective of the age, please remember, don't make a mistake over here as well. So if the assessee is a senior citizen or a super senior citizen, in default regime, that age criteria doesn't matter when you are applying your slab rates. See, if you come to next page, this is page number 2 of your chart book. See, up to 3 lakh. First 3 lakh nil, next 3 lakh 5, next 3 lakh 6 to 9, 10%. I believe that everybody is able to recall it. So above 15 lakh, it would be 30%. And the age does not matter in default tax regime. But in optional tax regime, it does matter. So what is the optional tax regime slab rates? 0 to 2.5 lakh nil. First 2.5 lakh nil, 2.5 lakh is the basic exemption limit. Next 2.5 lakh, that is 2.5 lakh to 5 lakh, it is 5%. Next 5 to 10 lakh, it is 20%. And above 10 lakh, it is 30%. Got it? So these are the optional slab rates. And in case the assessee is resident individual plus senior citizen, then the basic exemption limit would be 0 to 3 lakh. And if he or she is a resident super senior citizen, then 0 to 5 lakh would be nil. So I believe that you are able to recall this, right? So please make sure to apply the correct tax rates, right? Okay. Next thing is that can we change? See, the question can, especially the MCQ. So can we change from one regime to another regime any year? Generally, the answer is yes. For individual HUF, etc., they can change every year from default regime. They would like to opt out from it. They can change every year. But if the assessee has PGBP income, if the assessee has PGBP income, and once the assessee has followed default regime, then they cannot go back in optional regime, right? So if you have the PGBP income, and once you have chosen default regime, you cannot go back in optional regime until and unless you have the PGBP income. If let's say after 3, 4, 5 years, the assessee does not have PGBP income, now they can change. But otherwise, until and unless you have PGBP income, you cannot change. Once you are in default, you have to follow the default regime only, right? Second important thing is rebate. See, if you the rebate section is 87A. In fact, even if you don't remember the section, that is completely fine, but you should know the provision that how much rebate is available. See, rebate is available to those assessee whose income are not that much, right? Under default regime, it is 7 lakh. If your total income is up to 7 lakh rupees, then rebate would be available. How much is the rebate? Your tax on income. So tax on income or 25,000 rupees, whichever is lower, that is the rebate, right? Only if the total income is up to 7 lakh. If it is more than 7 lakh, then rebate would not be available. But there is a concept of marginal relief also under default regime. I'll be explaining it to you within a minute. But first of all, let us understand the rebate of the optional regime. See, in optional regime, if the assessee has opted out from it, so rebate is available only and only to resident individual assessee. And if only to individual. It is not even available to HUF. No, it is only and only for individual assessee, and that too for resident only under both the regimes. Correct. In optional regime, if the total income is up to 5 lakh, then only rebate is available. How much is the rebate? Tax on income or 12,500, whichever is lower, that is the rebate. Right? I believe that you are able to remember this. So 12,500 on tax on income, whichever is lower, that is the rebate. Also, please remember that rebate is not available from 112A income. So if you have 112A tax, so whenever you will be seeing this tax on income, so please just subtract whatever is the tax which is coming from 112A, because rebate is not available from 112, right? Okay. Now, under optional regime, if the total income is up to 5 lakh, then only rebate is available. If it is more than 5 lakh, let's say it says 5 lakh 10 rupees, then rebate is not available. But under default regime, there are cases when even if the income is little bit marginally increasing over and above 7 lakh, then also rebate could be available. Then also rebate could be available. So I believe that you remember that concept as well. So if the income is, let's say, 7 lakh 5,000, 7 lakh 10,000, 7 lakh 20,000, then you have to see whether that income which is marginally increasing, whether the income which is marginally increasing, is it more than the tax or not? So if it is more than the tax, then in that case, the rebate would be available. So I believe that you know how to calculate it. Should I give you an example for it? Okay. See, example. Let's say there is an individual whose total income is 7 lakh 20,000, right? Whose total income is 7 lakh 20,000. First of all, calculate tax on it. So first of all, we have to see whether it has any special income or not, whether it has any long-term capital gain, 111A, 112A, etc. So let's say the assessee does not have any special income, then we have to apply slab rates. So first of all, apply slab rates on it. So we understand we are following default regime, right? So let's say on first 3 lakh, the tax is nil. On next 3 lakh, the tax is 5%. And because it is 7 lakh 20,000, on remaining 1.2 lakh at a rate of 10%. It is 0, 3 lakh 5% is 15,000, 1.2 lakh 10% is 12,000. Got it? So this is 27,000. This is 27,000. Just call it A, right? Call it A. Now, calculate tax on 7 lakh plus additional income over and above 7 lakh. Plus additional income over and above 7 lakh. So additional income over and above 7 lakh is 20,000. Tax on 7 lakh. We understand that tax on 7 lakh is zero. Why? Because on 7 lakh, the tax rate is actually on first 3 lakh, it is nil. On next 3 lakh, 5% is 15,000. On next 1 lakh, right? If I will be calculating on 7 lakh. On 1 lakh, it would be 10,000, 25,000, and there would be rebate available. So tax on 7 lakh would be zero. Okay. So tax on 7 lakh would be zero plus 20,000. So this is equal to 20,000. Call it B, right? And if A is greater than B, if A is greater than B. So tell me whether A is greater than B. The answer is yes. A is 27,000, B is 20,000. If A is greater than B, then rebate would be A minus B, right? So how much would be the rebate? 7,000 would be the rebate. So 27,000 was the tax, 7,000 would be the rebate. So my tax would be 20,000. Now you can apply your 4% health and education cess. It would be 800. 20,800 would be your tax liability. Got it? So I believe that you are able to recall this provision also. I believe you must have done in your regular class or practice batches, etc. Right? So this is the concept of margin relief also in the case of default regime. But in case of optional regime, if my total income is little bit even exceeding more than 5 lakh, then we are not going to give them a rebate under optional regime. But here we can give them a rebate also, right? So whenever the income is little bit more than 7 lakh, 7 lakh, then rebate would be available. And I can give you a hint for your examination. If your income is 7 lakh, up to 7 lakh to 7 lakh 28,000 something, right? Then there could be a rebate. But if your income is more than 7 lakh 30,000 or so, then there would be no rebate, right? So it is just a hint for you. Okay. So this was the concept of rebate. And there is another concept of surcharge. See, if the surcharge is same for individual HUF, AOP, BOI, and artificial juridical person, I'm talking about, let's say, individual SSE. Let's say, first I will be starting with the default regime. So surcharge under default regime. See, the people who are rich, on them we will be applying surcharge. So please don't forget, whenever the total income is more than 50 lakh, then surcharge you have to apply. Correct. So how much surcharge would be applied? Surcharge is always on your tax amount. See, first of all, you have to compute the tax. And if the total income is more than 50 lakh, apply surcharge. Surcharge rate would be 10% also, 15% also, 25% also. In optional regime, it can go up to 37% also. So whatever is the surcharge rate, apply surcharge on tax. Correct? Not on income. It should be on tax. Correct? After that, tax plus surcharge, get this amount. And on this amount, you have to apply your health and education cess 4%. Got it? I'm again repeating. If the total income of the assessee for individual HUF, AOP, BOI, artificial juridical person, more importantly, individual. If the total income is more than 50 lakh, surcharge would always be there. Don't forget to apply surcharge. So first of all, compute your tax. Whatever is the tax, apply surcharge. Surcharge rate could be, it depends upon the category in which person, in which category, whether he is rich, whether he's super rich, whether he's ultra rich. So 10%, 15%, 25%. In optional regime, 37% also. So please apply that surcharge rate. Calculate the surcharge, add them together, tax plus surcharge, and then on this amount, you have to apply 4% health and education cess. I believe that is clear to you. Okay. Now let us see that how much would be the surcharge rate, whether it would be 10%, 15%, or more than 15% also, 25% or 37% also. See, in default regime, it is not 37, it is up to 25% only maximum. See, so what I'm doing it, I'm dividing this rich assessee into three categories: rich, super rich, ultra rich. Okay. So the people who are rich assessee, whose total income, where the total income is more than 50 lakh, but up to 1 crore, up to 100. The surcharge rate applicable would be, how much surcharge rate you will apply? 10% on your tax amount, right? So if their total income is 50 lakh to 1 crore, more than 50 lakh, in fact. So up to 50 lakh, no surcharge, but if it is more than 50 lakh, then surcharge would be applicable. 50 lakh, more than 50 lakh to 1 crore, 10%. If the person are super rich, their income is more than 1 crore, then they are in second level. So if the total income is more than 1 crore and up to rupees 2 crores, then the surcharge rate would be 15%. Got it? Easy. Now the third level. Please understand this third level in detail. Now, third level, we have to see the total income, but after excluding, third level would be if the total income after excluding, here we were not excluding anything. Here we were in first two levels, we were just seeing the total income. But in the third level, what we will see, total income after excluding, what we have to exclude, those stock market income. What are those? After excluding dividend income, 111A, short-term equity shares or equity-oriented units sold on stock exchange, 112A, long-term equity shares, equity-oriented units, or 112. What is 112? Long-term capital gain, any other long-term capital gain. After excluding them, if it exceeds rupees 2 crores, if it exceeds rupees 2 crore, then this person would be in third level, right? If it exceeds more than 2 crores, then it would be, this person would be in third level. And here the surcharge rate would be 25% also and 15% also. Why 25 and 15? Why? Because the income which is exceeding more than, which is exceeding after excluding them, because on these income you will apply only 15% surcharge rate. So whatever is the tax on this income, the surcharge is always on tax. So whatever is the tax on these income, you will be applying 15% on that tax. And whatever is the tax on the remaining income, you will apply 25%. Got it? And the last point is, if the income is, total income is more than 2 crores. See, if the total income is more than 2 crores, then this person is not in first level, he is not in second level. Why? Because the total income is more than 2 crores. But he is not coming under third level also. Why he is not coming under third level? Because total income after excluding this was not exceeding 2 crores. Before it was exceeding 2 crores, but after excluding this, it is not exceeding 2 crores. Then in that case, you will apply 15% rate on all the taxes. Got it? So if this person is not in any level, please apply 15% rate. So this is an important point regarding surcharge under default regime. Under optional regime, it is also very similar. Under optional regime, what you have to do? First two levels are same. Total income is more than 50 lakh to 1 crore, 10%. More than 1 crore to 2 crores, 15%. Third level, total income excluding this exceeds 2 crores, but up to 5 crores. If it is up to 5 crores, then 25% on that income, but on these type of taxes, 15%. And the fourth level, there is one more level, fourth level in optional regime. If the total income after excluding them exceeds 5 crores, then 37% on that income, and on these income, 15% only. Right? So I believe that you are able to recall your surcharge provisions also. Got it? So these are the important point in the first chapter of basic concepts. Second, what you can remember in the first chapter is that there are certain income which are taxable in the previous year itself. We will not wait for the assessment year. They will be taxable in the previous year itself. Why? Because there might be, the assessing officer will might not be able to recover the tax in the assessment year. So if a person is leaving India with no intention of coming back, or he is just disposing all his property to await the taxes, or if this person has discontinued the business, then in that case, or AOP and BOI is formed for a very special purpose, and now they will be dissolved. So in that case, please collect the tax in the previous year itself. Right? So that is also important point. Now come to, see, this chapter is very, very important from your examination point of view. Every time you can see the questions are coming from this chapter as well. And it is one of the easiest chapter of Income Tax Act. Please don't lose marks over there. Okay. Residential status and scope of total income. Mostly the most important assessee for us is individual assessee. Although they can sometimes ask for HUF also, but mostly individual is most important. Okay. See, individual can either be resident or a non-resident. And if the assessee, the individual is a resident, then we have to further determine whether it is ordinary or not ordinary resident. See, if your answer comes, he's a non-resident. So simply your question stops there. You don't have to determine further. But if the individual is resident, please do determine whether he is ordinary or a not ordinary resident. Correct. Now, how you will be determining the residential status of individual? So we all know that there are two basic conditions. We all know that there are two basic conditions. Any of the condition gets satisfied, the individual would be resident assessee, right? If both the conditions are not satisfied, then we can say simply the assessee is a non-resident. But if any of the condition is satisfied, resident assessee. And once resident, determine further ordinary or not ordinary. Got it? Now, what are the basic conditions? The stay in India should be 182 days or more. If it is 181, no. At least the stay should be 182 days or more, then the assessee would be resident. So if first condition is satisfied, no need to check the second condition because we need only one. Any one should be satisfied. So it is satisfied 182 days, assessee would be resident. We'll further check ordinary, not ordinary. How will we check? I'll be discussing with you within a minute. If this is not satisfied, if 182 days condition is not satisfied, then you can see the second condition also. Second condition says the stay during the previous year in India. See, whenever we say in India, it could be in any part of India, including the territorial waters of India. Correct? And the day of arrival as well as the day of departure, both should be included as a stay in India. So it says, second condition says that if the stay in India during the previous year is 60 days or more, 60 days or more, plus in last 4 years, it is 365 days or more. Plus in last 4 years, it is 365 days or more, then also the assessee would be a resident. So if this condition is not satisfied, but this is satisfied, we will say resident assessee. But again, a very, very important point of this chapter is in some cases, we will not see this condition. We will not apply this condition. We will apply only 182 days conditions in these three cases. What are these three cases? So in these three cases, 1, 2, and 3, we will apply only 182 days condition. We will not apply 60 days condition. Very, very important point. I'm saying that one of the common point in all these three is that the assessee is an Indian citizen. In the third point, it could be person of Indian origin also, but mostly speaking, majorly speaking, the assessee is an Indian citizen. He is not a foreign citizen. He is an Indian citizen. So if an Indian citizen is leaving India during the previous year for employment outside, the first point says if he is leaving India for the employment outside, whether he's got a job outside or he would be starting his business or profession outside, it means that he is leaving India for employment outside during the previous year. Then we will not see 60 days condition, we will only see 182 days condition, right? But this person should be an Indian citizen. If a foreign citizen is living outside, then you can see both the condition. I'm saying it is an Indian citizen only, then you will not see 60 days, you will see only 182 days. Got it? Second, if the assessee is an Indian citizen, crew member of an Indian ship, and he's an Indian citizen, then also we will not see this condition. We will see only 182 days condition. So this person is in India for 181 days, non-resident. Simply we'll say non-resident. But this person is in India for 182 days or more, resident assessee. Got it? So second is Indian citizen, crew member of Indian ship. Third is Indian citizen who comes to visit India, who generally he or she is living outside, but he's coming to visit India and he's an Indian citizen. And here, either he could be an Indian citizen or a person of Indian origin. We all know what is a person of Indian origin, whose parents or grandparents were born in any of the parents or any of the grandparents were born in undivided India. So that person is called person of Indian origin. So in all three cases, majorly you see that Indian citizen is common over here. Indian citizen is common over here, right? So if any of this condition is, if this person is falling in under any of these exception, please don't see this condition, only 182 days condition you have to see. Got it? Easy. So please never get confused. So if your question says that the assessee is a foreign citizen, comes to visit India, then you can see both the conditions. Why? Because these conditions are only for Indian citizens, right? But please remember in third one, it could be person of Indian origin also. If he is not an Indian citizen, either he or she could be person of Indian origin also. Okay. Now, if this person is a non-resident, then full stop. We don't have to determine any further. If the person is a resident, any of the condition is satisfied. In these cases, this condition is satisfied. Assessee becomes a resident. Further, you have to check ordinary or not ordinary. How you will check? You will apply two conditions over there. First, apply a simple condition of last 7 years of the previous year. Our previous year is 23-24. Just leave this previous year. Go back in last 7 years. So in 7 years, if the total period of stay, number of days of stay, 730 days, 730 days or more, then the first condition is satisfied. Can we say ordinary right now? No. Both the conditions should be satisfied. So first condition is 730 days. Second condition should also be satisfied, which says out of last 10 years, Previous year is 23, 24. Forget about that. Last 10 years. Out of last 10 years, that the assessee should be in at least 2 years. In at least 2 years, this assessee should be resident. Just resident. We don't need ordinary, not ordinary. We need just resident. So 2 out of 10, in minimum 2, he should be resident. So if both the conditions are satisfied, then the assessee is ordinary resident. Otherwise, the assessee would be not ordinary resident. Got it? Able to recall this? Now, very, very important point, and 70-80% of the chances that examiner will ask you about these special provisions. What are these special provisions? See, we have special provision number 1, we have special provision number 2. We will come to the special provision if the income from Indian sources is more than 15 lakh. Income from Indian sources is more than 15 lakh. Generally, the law uses this phrase. What is Indian sources? They use it actually in a negative sense, other than foreign sources. See, it is same like na, other than foreign. Other than foreign is what? Indian. So they use this phrase, other than foreign sources. Other than foreign is same as Indian sources. So if the person Indian source income is more than 15 lakh, then you can come in special provisions, right? So first of all, understand what is Indian source or other than foreign sources income. Any income which arises in India is an Indian source income. Any income which is received in India, whenever I say arise, deemed to arise is also included. Whenever I say receive, deemed to receive is also included over there, right? So if the income is arising in India or deemed to arise in India or received in India or deemed to receive in India, this is Indian source income. The third one is very important. If the income does not arise in India, does not receive in India, but controlled from India, it is controlled from India, this is also an Indian source income. This is also an Indian source income. If the total of this income, arise in India, received in India, controlled from India, right? If the total of this income exceeds 15 lakh, if it exceeds 15 lakh, we will say that yes, the special provisions can be attracted over. Correct? So if the income from Indian sources, I can say other than foreign sources exceeding 15 lakh, then the special provisions would be attracted. Got it? Now, guys, second important thing, these special provisions are again mostly for Indian citizens only. The first special provision is for Indian citizen. It could be for person of Indian origin also. But the second is again, it is for Indian citizen only. So again, this Indian citizen is very important in our residential status chapter. This Indian citizen word is very important for us. Those three exceptions are mostly for Indian citizen. These special provisions are also mostly for Indian citizen. First provision is for person of Indian origin also is there, but mostly it is Indian citizen, right? So if your income is more than 15 lakh, which income? Not the total income, not any other income. For your Indian sources income, other than foreign sources income is more than 15 lakh, plus the assessee is an Indian citizen or person of Indian origin, then we will not see those basic conditions. We will see other conditions. So what are the conditions over here? Here the basic condition would be changed for him. So what we have to do? We have to see either 182 days or more in previous year, or here we will not see 60 days over here. We will see 182 days in the previous year plus 365 days in last 4 years. If any of them is satisfied, then he will become resident. Got it? I'm again repeating. Now, if the assessee's Indian source income, other than foreign sources income, is exceeding 15 lakh, and this assessee is either an Indian citizen or person of Indian origin, then how you will be determining the residential status? See, if it is 182 days or more, then he would be a resident assessee. If this condition is not satisfied, but at least he is in India, he or she is in India for at least 120 days, 120 days or more during the previous year, plus in last 4 years, plus in last 4 years 365 days or more, then also if any of the condition is satisfied, the assessee would be a resident. And how we will check ordinary, not ordinary in this case? Should we check 730 days, 2 out of 10? No. It has its own criteria of determining the ordinary or not ordinary residential status. So how we have to see? So if this person is in India for 182 days or more, so this person will become ordinary resident, right? So if this person is satisfying 182 days or more, then ordinary resident, otherwise not ordinary. Got it? I'm again repeating. If this person, for other than foreign sources income, that is Indian sources income, if the Indian sources income is more than 15 lakh, is more than 15 lakh, right? What is Indian source income? Arise in India, deemed to arise in India, received in India, deemed to receive in India, or it is not arising, not getting received, but it is controlled from India. That is also Indian source income. If this income is more than 15 lakh and the assessee is an Indian citizen or person of Indian origin, then we will see the basic conditions are changed here. Any of the basic condition, either 182 days or 120 days plus 365 days is satisfied. Any of them is satisfied, the assessee would be resident. And to determine ordinary or not ordinary, if this person is satisfying this condition, then ordinary. Otherwise, his stay is, although it was 120 days or more, but it is less than 182 days, then he would be not ordinary. Simple terms, I can say, if the assessee has satisfied this condition, ordinary. If the assessee has not satisfied this condition but satisfied this condition, then not ordinary. Got it? Second, if this condition would be applicable if the person is an Indian citizen, his Indian source income is more than 15 lakh, and he is living in such a country where there is no tax, because of his residential status, because of his domicile, etc. So he is living in such a country that is a tax haven. In that case, second special provision would be followed. And if second special provision is followed, this is called a deemed resident. He will be deemed to be resident. Deemed to be resident. He would be called as deemed resident, even if he did not come to India at all. Let's say if his number of days of India stay in India is 0, then also this person is called as a deemed resident. And such, if he's a deemed resident, such deemed resident is always resident, but not ordinary resident. RNOR, right? He would be resident, but not ordinary resident. In this case, always, they can never be deemed resident, can never be ordinary. They will always be not ordinary. Got it? So this was an important concept, right? What is income from foreign sources or other than foreign sources? You all know it now, right? Residential status of HUF. Sometimes they can ask you about the residential status of HUF. See, if 100%, if 100% control or management is outside India of the HUF would be non-resident. Even if partial control is in India, even if 1% control of HUF is in India, this HUF would be called as a resident assessee. Then once it is resident, how will we determining ordinary or not ordinary? We'll apply the additional conditions on Karta. We'll apply those additional conditions. What are those additional conditions? Those old additional conditions. 730 days or more, 2 out of 10 years, whether that Karta is resident or non-resident. So if both the additional conditions are satisfied by Karta, this HUF will become ordinary resident. Otherwise, HUF will become not ordinary. Got it? So again, I am repeating, if 100% control is outside India, simply non-resident. Full stop. Answer done. Non-resident. But if even 1% control is in India, then resident. And if resident, we have to determine the ordinary or not ordinary, apply additional conditions on Karta. Right? So these two are important. Mostly individual residential status is important. Sometimes HUF also. Now, the second type of question which you get in your examination is about the scope of income. See, always remember that any income which arise in India, whether arise in India or deemed to arise in India. To arise in India, it is always taxable. Whether the assessee is ordinary resident, resident but not ordinary resident, resident, not ordinary resident, or non resident. See, if income is arising in India or deemed to arising in India, Indian tax authorities have full control over that income. So, our Nirmala Sitharaman ma'am will say, boss, this income is arising in India, does not depend on your residential status. So, always it will be taxable. So, always it will be taxable irrespective of the residential status. Got it? Any income which is received in India or deemed to be received in India, it is always, we will say, it will always be taxable, irrespective of your residential status. So, if income is directly received, not remittance, I'm not saying remittance, if it is received in India or deemed to be received in India, it is always taxable, irrespective of your residential status. Third type of income is income which is not arising in India, neither it is arising in India, nor it is received in India, nor it is received in India. So this type of income could be taxable also, could be not taxable also. For this type of income, this chapter is important. Residential status is important only for this type of income. See, because here, whatever is your residential status does not matter. Here, any income which is arising in India, everybody is going to pay tax. Any income which is received in India, everybody will going to pay tax. Correct? Any income which does not arise in India nor received in India. Ordinary resident global income is taxable. We all know he has to pay tax. He has to pay tax. Ordinary resident global income is taxable. Please make it taxable there. For not ordinary, please don't tax. Not sorry, for non-resident, he will say, why I will pay tax? Because this income is not arising in India, nor received in India, and I am a non-resident. For non-resident, please don't take tax from him. Now, for not ordinary, it could be yes also, it could be no also. It depends upon the control. It depends on the control. So whether it is controlled from India or not. So if it is controlled from India, although it is not arising nor received, but if it is controlled from India, then not ordinary will pay tax on it. But if it is neither controlled from India, then he will not pay tax. Please remember, guys, don't make a mistake over here. This control word is only and only important for not ordinary, right? This control word is not important for non-resident. This is not important for ordinary resident also. See, ordinary resident is always taxable. His global income is taxable. Whether it is controlled from India, is not controlled from India, doesn't matter. See, ordinary resident is a poor guy. He has poor means in the terms that he has to pay tax anyways, right? Non-resident, even if it is controlled, that control word does not matter to non-resident. He will say, I will not going to pay tax because this income is not arising nor getting received in India, right? But not ordinary will pay tax if it is controlled. It is not arising nor received, but if it is controlled from India, yes. If it is not controlled, no. Got it? So please remember this thing also. So this is important. Another important point which I would like to discuss in residential status is regarding interest, royalty, and fees for technical service. I'm discussing about interest. I think that you will be able to recall those royalty and fees for technical services portion also. So if there is an interest income of a non-resident is having a interest income, is getting an interest income. Why? Because he has lent this money. He has lent this money, and he has lent this money either to government of India or to resident or to non-resident, right? So let's say, let's say this non-resident, his name is Paul, correct? Let us first understand regarding this. Let's say I'm a resident, I have taken a money. I have taken, let's say, 20 lakh rupees from Paul at a rate of 12% per annum. That is 2.4 lakh rupees interest income. So this Paul is receiving 2.4 lakh rupees interest income. Now the question is whether this 2.4 lakh rupees is taxable in the hands of Paul or not, right? Very, very important point regarding examination. That's the reason I am discussing it separately. So now the question is, now the subject matter is, guys, that whether this 2.4 lakh is taxable in the hands of Paul or not. Paul is a non-resident, right? And he is getting an interest income. From where he is getting, let us take this example, he is getting from resident. Let's say I have taken this money on loan from him. So I'm here, Rajat. I'm a resident. I have taken loan from him and I'm paying him 2.4 lakh rupees. So now it depends where I am using this money. See, if I am using this money in my business in India, in my own business in India, if I am using this money in my own business in India and I am paying him 2.4 lakh, it would be taxable, right? So this is called, it is my own business in India. I have directly invested this money. I have taken 20 lakh rupees from him and I have made a direct investment in my business. This is called direct investment. I've invested it directly in my business. Even if I have done an indirect investment, what it is, I have not invested in my business, I have invested in some other business. What does it mean? It means that if I have purchased some shares or other securities or debentures, etc., of Indian company in India, let's say I have purchased Reliance shares, I have purchased Infosys debentures, any Indian company shares or debentures. Again, I'm using this money in India. So this is called indirect investment. This is called indirect investment, right? So whether I have made, I am a resident, I am paying 2.4 lakh. Are you able to get this 2.4 lakh rupees? Because 20 lakh rupees I have taken it from him, on which I am paying 12% interest. That is 2.4 lakh rupees to him. So let's say if I have made either a direct investment in India or I have made an indirect investment in India, in both the cases, Paul is liable to pay tax in India. So his income is arising, his income will be taxable in India. So 2.4 lakh, we will say, Paul, you have to pay tax on it. Got it? Now, the question will give you some points. Let's say they will say there is a non-resident Paul, there is a resident Rajat. He has invested in his Sri Lanka business, and he's paying 2.4 lakh to Paul. Whether it is taxable? No, because that money is not invested in India, right? So whether if I am, see, some students will make this mistake. See, sir, resident is paying, so it means that this income is taxable in the hands of Paul. No. So resident is paying, resident could be there. They can even give you Indian companies there. Indian companies also resident, right? So if any borrower is a resident, let's say it's an Indian company, and they are using it money in Sri Lanka, they are using this money in, let's say, Australia, UK, US, etc. So please don't make it taxable. Why? Because resident, if it is paying money, if it is used in his Indian business, whether directly or in any other a business in India, that is shares, debenture, other securities I have purchased, indirect investment in India, then this income would be taxable in the hands of Paul. So whatever the interest which he is receiving, 2.4 lakh rupees, that would be taxable. Got it? Now, let's say non-resident has borrowed this money. Paul is a non-resident and another non-resident, let's say his name is Adam. His name is Adam. Adam has borrowed this money. Adam has borrowed this money. And if Adam is making a direct investment in India, direct investment means in Adam's business in India, Adam's business in India, he is doing his own business in India and he has invested this money in India. And because of it, because he has taken a loan, he is paying 2.4 lakh rupees, it will be taxable. It will be taxable in the hands of got it? 2.4 lakh would be taxable. But if Adam makes an indirect investment in India, indirect investment, he is not opened his own business, but he has purchased some Indian shares or Indian debentures, then please don't make it taxable. So whatever the loan interest which he is giving, 2.4 lakh, in that case, it will not be taxable. So here, please remember, when resident has borrowed, whether he is making direct investment, whether he is making indirect investment, in both cases, 2.4 lakh is taxable in the hands of Paul. But in case of non-resident is the borrower, only in case of direct investment in India would be taxable. Got it? This is not that important, but government of India, if has borrowed money from a non-resident, let's say it's a non-resident company and we have borrowed, government of India has borrowed, and this money they can use it anywhere, anywhere in the world, anywhere, not only in India, anywhere in the world they can use it. it will always be taxable. Government of India, whenever they will pay money to Paul, it will always be taxable. So what I have written is the taxability. So government of India, they are using this money anywhere. When they will be paying 2.4 lakh rupees to non-resident, non-resident is liable to pay tax. Resident has borrowed the money. In these two cases, it would be taxable. Non-resident has borrowed the money, and if he has made only the direct investment, then only this 2.4 lakh would be taxable. Got it? The same concept is for royalty. The same concept is for fees for technical services. What you need to see over there, where it is getting used. If we are paying royalty to someone and we are using that copyright, etc., outside India, don't make it taxable. But if we are using that in India, please make it taxable. Right? Got it? This was again important regarding residential status. Now let us come to the next chapter, that is salary. Next chapter is salary. Salary chapter is quite easy and also important from examination point of view. Whenever you will get the question for salary, so what you need to do is just make a list of all the things which you are getting. See, there are only three sections in salary: section 15, 16, and 17. 16 is deductions from gross salary. We know, I'll be discussing that also. Section 15 is a charging section of salary. It says that if the payer, the person who is paying the money, is the employer, the person who is receiving the money is an employee, if this relationship exists, then it will be salary income. Otherwise, it will not be a salary income. We know that whenever a partner receives salary from their partnership firm, see, partner is not an employee. He's not a servant of the firm. In fact, he's the owner of the firm. So in that case, whenever the partner receives any remuneration, it is not salary income. We understand it is PGBP. I'll talk about that in PGBP also. Whenever these MPs, MLAs receive salary from government, government is not their employer, right? So their income is not taxable under their salary. It will be taxable under IFOS. So we understand section 15 says that there should be a relationship of employee and employer. Correct. Second thing, salary is taxable on due basis or receipt basis, whichever is earlier. We all know. So whenever the salary gets due, in fact, if you have not received it, but if it gets due during your previous year, our previous year is 23, 24. If it gets due in this year, it will be taxable. That we all know, right? Now, talking about from examination point of view, when you will get your salary income, first of all, write all the things which we are getting from your employer. So let's say if I'm computing a salary income, for example, I got the salary question in my examination. So let's say when I'll be computing my salary income, first of all, make the list of all these components. Let's say you are receiving basic salary, you are receiving DNS allowance, you are receiving bonus, you are receiving commission in any form you are receiving. Please make it a list of everything. These four components are always fully taxable. Basic salary, fully taxable, DA, whether it forms part, whether it does not form part, right now, please make it fully taxable, right? So whenever you will get this thing like DA is 20% of basic, 60% forming part, 70% forming part, that whatever the portion which forms part, right now, you don't have to do anything of it. First of all, please make it fully taxable, right? Bonus is always fully taxable. Commission is also fully taxable. Now, any type of allowances which you are getting, please make the list of all these allowances. We understand there are two types of allowances. One is official allowance, other is personal allowance, right? See, any type of allowances which you are getting, traveling allowance, transport allowance, servant allowance, lunch allowance, just make a list of it. I'm just to make you understand, to make you revise, I'm just briefing about allowances. Allowances are of two types. One is official allowance, other is personal allowances. Official allowances are exempt. These are not taxable. You all know it. These are exempt allowances because this is not for the benefit of the employee. This is for the benefit of the employer. So what are the examples of official allowances? You know, traveling allowance. What is traveling allowance? If your employer is sending you outside the city, let's say for you are working in a CA firm and that firm is sending you for an outstation audit. So let's say you're working in Chennai and they are sending you to Madurai. So in that case, they will give you a traveling allowance. So traveling allowances are purely official allowances. So it will not be taxable. Similarly, daily allowances. Daily allowances, because if you will be working there, let's say for 15 days, you have gone to outstation audit. So for 15 days, you will be living over there. You will be having some local transportation expenses. You will be having some local food expenses, other hotel expenses, etc. So for that, they can give you daily allowances, traveling allowances, daily allowances, conveyance allowance. What is conveyance allowance? When you travel for office purpose within the city itself, within your city itself, when you travel, that is called conveyance. So traveling is outside the city for official purpose. Conveyance is within the city for local official purpose only. Then you might be having uniform allowance, research allowance. These all are traveling. These all are official allowances, and they will not be taxable under both the schemes. Whether you are following optional regime, whether you are following default regime, these allowances are purely exempt in the hands of employee. So just make a list of it first of all, and then when you will be writing about the taxability, you can straight away write exempt. These are exempt expenses. But yes, if there is any saving out of official allowances, if there is any saving, so let's say the employee, you have been given in the question that the employee is receiving traveling allowances, let's say 5,000 per month, and he's saving 1,000 rupees per month, and he's not giving this back. Let's say there is simply it is written that he's saving 1,000 rupees per month. So any saving would be taxable. And in both the regimes, the taxability would be same. Got it? Okay. Personal allowances. Personal allowances are for our benefit. So whatever the money which we can take home, mostly all the allowances, mostly I can say 99% allowances are personal allowances. So there are various examples of personal allowances. House rent allowance is your personal allowance. Servant allowance is your personal allowance. Transport allowance. What is transport allowance? The allowance which has been given to you for commuting between the home and office, right? From home to office and then from office to back. That is called transport allowance. These all are servant allowance, meal allowances, medical allowances. I'm not saying medical facilities. I'm saying medical allowances, meal allowance, medical allowance. These all are overtime allowance. Whatever you can take to your home, these are all our personal allowances. So personal allowances should be fully taxable because these are the part of your income. So under both the regimes, the personal allowances should be taxable, right? Personal allowances are taxable allowances. Anytime, whatever the allowances which you are getting, let's say if there is any very new type of allowances which you have never heard of it, which you have never seen before, please make it fully taxable, right? So personal allowances are fully taxable under both the regimes. But under optional regime, some personal allowances are exempt. Some personal allowances are exempt up to a certain limit. I'm again repeating, personal allowances are generally taxable because it is your money, because you can take it to your home. So it should be taxable. It should form part of your gross salary. Got it? Under both the regimes, it should be taxable. But under optional regime, there are few personal allowances which are exempt. What are those? HRA is one. Children education allowance. I'm telling you the most which are common. Children education allowance, hostel allowance, underground allowance. Underground allowance not so important, but still I'm discussing this also. Underground allowance. So HRA is exempt up to a certain limit. I'll tell you what is the exemption over here. Children education allowance. It is exempt up to 100 rupees per month per child, maximum up to two children. Are you able to recall it? 100 rupees per month per child, up to maximum two children. So first you have to see that for each child how much amount we are receiving, and for only two children you can make it exempt. It is not for grandchildren. Children always include in income tax act. Children always includes adopted child and as well as stepchild. Correct. Hostel allowance 300 rupees per month per child for up to maximum two children. Maximum two children. Got it. Underground allowance not so important, but yes, it is exempt up to 100 rupees, 800 rupees per month. Underground allowance is 800 rupees per month. There is one more allowance which is called outstation allowance. So outstation allowance is generally given to the employees who are working in a transportation industry. So let's say a driver, truck driver, etc. They are provided outstation allowance. It is exempt up to 70% of such allowance, 70% of such allowance, or rupees 10,000 per month, whichever is lower. Got it? Are you able to recall this? But these allowances are exempt only under optional regime if you are following default regime, and generally in examination, the mostly now the trend is they are asking about your default regime. They all will be taxable. So there would be no problem. They all would be taxable. But here, they would be exempt. What about house rent allowances? House rent allowances exempt under optional regime up to least of the following. There are three things which you have to see in HRA. See, least of the following would be exempt: actual HRA, rent paid minus 10% of salary, or 40% of salary, or 50% of the salary. You understand, 50% of the salary we have to take if the rent which where it is being paid, it is Delhi, Mumbai, Kolkata, and Chennai. Then we will be taking 50% of the salary, Delhi, Mumbai, Kolkata, and Chennai. Otherwise, 40% of the salary. Now, for the purpose of salary, what is the definition of salary over here? Retirement benefit salary. Three components are included over there: basic salary, DA forming part of retirement benefits. If it forms part, if it is given that DA forms part, then only you have to take that DA. Otherwise, you don't have to take that DA, right? So, retirement benefit salary means basic salary, DA forming part, plus fixed percentage commission on turnover. Only that commission which is fixed in percentage on turnover, that should only be taken. Correct? But HRA, I'm saying that these allowances are personal, but they are exempt up to a certain limit only under optional regime. Under default regime, please make them fully taxable. Under default, they are fully taxable. Got it? So, what I'm saying to you, that whenever you will get the salary question, please make the list of all the things which you are getting: basic salary, DNS allowance, bonus, commission, all allowances. Please make the list, and then thereafter you have to determine whether it is fully taxable or it is not taxable, right? Okay. Then we have perquisites. Perquisites. So perquisites, the most important perquisites is rent-free accommodation, motor car facility, education facility, interest on loan, sale of assets. So I'll be discussing all of them. So these are the perquisites. Generally, in both the regimes, the valuation is same under both the regimes. Only in LTC, there is certain exemption in optional scheme, but in default regime, it is fully taxable. So whatever the perquisites which you are getting, you have to make a list of it. Then retirement benefits. Retirement benefits can be employer contribution to provident fund. It could be your gratuity, pension, or leave salary, etc. So these retirement benefits, first of all, you have to make a list of it. Correct? How much would be taxable? How much would be exempt? I'm just explaining. So once you have made the list of it, then you have to determine whether it is fully taxable or it is partially exempt or fully exempt, right? So when you will be doing the total, you will get the gross salary. So this total is called gross salary. Got it? This is called gross salary. From gross salary, there is a deduction under section 16. Under section 16, you have to give deductions. There are three deductions: standard deduction, tax on employment, and entertainment allowance deduction. Standard deduction is available under both the regimes. How much it is? Gross salary or 50,000. Generally, it will be 50,000 rupees. Gross salary or 50,000, whichever is lower. So please always give standard deduction, right? So whenever you are computing your salary income, please give standard deduction under both the regimes. Under both the regime, whether you are following optional, whether you are following default, 50,000 rupees should be given maximum, right? Gross salary of 50,000 rupees, whichever is lower. Other two deductions, entertainment allowance deduction or tax on employment deduction, are only and only available under optional regime. They are not available under default regime. Got it? So what about entertainment allowance deduction? See, first of all, if we are getting entertainment allowance is a personal allowance. Entertainment allowance is a personal allowance. So first of all, if the assessee is getting entertainment allowance, please first of all make it taxable. For everybody, make it taxable. First of all, make it part of your gross salary. Then there is a deduction available, but deduction is available only and only if the assessee is following optional regime. Second thing, it is only available if the employee is a central government or a state government employee. That's it. For other employees, in optional regime also, entertainment allowance deduction is not available. So what is the limit of entertainment allowance deduction? See, it should be least of the following: actual entertainment allowance received, whatever is the actual entertainment allowance received, that deduction, or 1/5 of the basic salary. You can say 1/5 or 20%, whatever is the same. 1/5 or 20%. 1/5 is nothing but 20%. So 20% of the basic salary or 1/5 of basic salary, or rupees 5,000. It is 5,000 per month, per annum? No. 5,000 is a straight fixed limit. So, or rupees 5,000, whichever is lower. But please remember, it is under optional regime, and that to this particular deduction is only and only to central government and state government employees only. That's it. Nobody else, right? Then tax on employment. This again deduction is only and only available under optional regime. It is not available under default regime. So if the assessee has paid, or even the employer has paid the tax on employment, you will get the deduction. So whatever the tax is paid, and this deduction is only available on payment basis. What does payment basis means? That in the previous year 23-24, starting from 1st April 23 till 31st March 24, in this 365 days or 366 days, it's a leap year. So whatever is paid during this year, right, up to the due date of ROI, no, due date of ROI is the concept of PGBP. It is not a concept of salary. So whatever is paid during this 365 or 366 days is allowed, right? Whether the employee is paying, whether the employer is paying, both are allowed, right? So anyone who is paying it, it will be allowed as a deduction for the employee, right? If both are paying, so whatever the amount which both are paying, that will be allowed as a deduction. But if the employer is paying, so first of all, it is a perquisite for us. Why? Because it is our obligation which the employer is meeting. So if it is our obligation, first of all, let's say tax on employment is paid, let's say rupees 4,000, and it has been given that 3,000 is paid by the employer and 1,000 is paid by the employee, right? So 4,000 is the tax on employment or professional tax, it is paid. So first of all, you will get the 4,000 rupees reduction. 4,000 rupees reduction you will get, whether you have paid it, whether your employer has paid it. Deduction, if you are following optional regime, then only. In default regime, it is not, the deduction is not available. Got it? So 4,000 you will get the deduction. But since 3,000 is paid by the employer, it will become first your perquisite, right? So it will become first part of your gross salary. Then you can give the deduction, right? So then you can give this deduction is only under optional regime. I'm again repeating. Got it? So these are the deduction under section 16. So then you will get your salary income. Now let us understand more about perquisites. Foregoing of salary you will not get. Foregoing of salary, what does foregoing of salary surrender? You will not get this in your examination, but what does it mean? Foregoing of salary means when you don't take your salary yourself, you divert the salary to someone else, then also it will not make any difference. It will be taxable in your hands, right? What does surrender of salary mean? Surrender of salary means that you will say, I will not take salary at all. So if you will not take salary at all, then it will not be your income. But foregoing of salary is your income, right? Okay. One of the important perquisite is rent-free accommodation, RFA, which we shortly call it RFA, rent-free accommodation. See, rent-free accommodation is quite an important perquisite from examination point of view. Rent-free accommodation. Now there is a change. There is an amendment which came from 1st September onwards, 1st September 23 onwards. So first of all, if the rent-free accommodation is provided to you for the entire year, from April 23 till August 23, these 5 months, April, May, June, July, August, these 5 months, you have to follow old provisions, right? And there the amendment was there from September onwards. So from September 2023 till March 24, you have to apply new provision. For these 7 months, you have to apply new provisions. See, if the accommodation is provided, there might be cases that your examiner can ask you, then they will give you in your question that rent-free accommodation is provided from September onwards or October onwards, anywhere in this period. So there is no problem, because if it is provided here, then we have to apply only new provision. But in case the accommodation is provided for the entire year, then for these 5 months, till any period, if the accommodation is provided in any period over here, so here it should be old provision, and here you have to follow new provisions. Now, what were old provisions and new provisions? See, now we understand that whether the accommodation is owned by the employer or it is hired by the employer. So whether it is owned by the employer or it is hired by the employer. If it is owned by the employer, then your perquisite is based on population of the city where this accommodation is provided to you. So if it is owned by the employer, please remember, if the population is up to 10 lakh, first category. Second category is more than 10 lakh, up to 25 lakh. Third category is more than 25 lakh. Correct? I'm again repeating, these are the old provisions. If the accommodation is owned by the, it is owned by the employer, then population based, you have to find out the rent free accommodation. So if it is up to 10 lakh, the population of that city is up to 10 lakh, that is, it's a small city. Then your perquisite value will become 7.5% of RFA value, or RFA salary, I can say. What is RFA salary? I'll be discussing that with you. So here it is 7.5%. If the population of that city is more than 10 lakh but up to 25 lakh, then 10% of RFA salary. And if it is more than 25 lakh, then 15% of RFA salary. What is RFA salary? I'll be discussing with you, right? So these are the values of perquisite. If it is higher, then actual higher charges or 15% of RFA salary, whichever is lower. So in case of hired, the population does not matter. In case of hired property, the population does not matter. You have to take actual higher charges or 15% of RFA salary, whichever is lower. Got it? Right? Now, what are the new provisions? If the accommodation is provided to you from September 23 onwards to March 2024 onwards, right? And if it is for the entire year, for first 5 months till August, you have to follow all old provisions, and thereafter you have to follow new provisions. What are the new provision? If it is owned by the employer, now because the population is increasing day by day, so now this 10 lakh rupees, this 10 lakh number of population is increased to 15 lakh. So if it is up to 15 lakh, then 7.5% is reduced to 5%. 5% of RFA salary. If it is more than 15 lakh up to 40 lakh, then it is 7.5%. And if it is more than 40 lakh of population of the city where the accommodation is provided, where the population is more than 40 lakh, then you have to take 10%. In case the question is silent about the population, then you can assume. And generally, I would suggest that please assume that the population of the city is more than 40 lakh rupees, right? Just like write one line over there. If the population is missing in your question, generally 99% I am saying that the population will be given to you. In case 1%, if it is missing in the question, then because it is owned by the employer, you need population. And if it is missing, then please assume that the population of that particular area is more than 40 lakh rupees, then you can safely apply 10% of RF, right? And if it is hired by the employer, then actual higher charges or 10% of RFA salary. Actual higher charges or 10% of the RFA salary, whichever is lower, right? In case of hired, population does not matter. The population value does not matter, right? Okay. Now, what is RFA salary? What is RFA salary? See, RFA salary is very easy. In RFA salary, you will include almost most of the things, but you will not include perquisites, you will not include retirement benefits. So in RFA salary, most of the things are included, but please don't include any perquisite. Perquisite is not included in RFA salary. Retirement benefits, retirement benefits are not included in RFA salary. So what will be included? RFA salary means DNA, basic salary, DA if it forms part of retirement benefits, plus all taxable allowances. It includes all allowances, all taxable portion of allowances. See, if any allowances is exempt, then please don't make it the part of your RFA salary. Only the taxable portion of the allowances has to be made part of this RFA salary, right? So all taxable allowances plus bonus plus commission. Any type of commission, whether it is based on turnover, whether it is not based on turnover, doesn't matter. Any type of commission, you have to include it. Generally, I'm giving you a trick. First of all, just see your question. First of all, once you have made the list, your list will tell you whether you have to include it or not. Please, in RFA salary, do not include perquisites, do not include retirement benefits, right? And most important thing is that if the employee is simultaneously working with more than two employers, let's say he is working with A Limited also, and he is working with B Limited also simultaneously, and he has been provided accommodation from A Limited, then you have to take, when you will be taking your 7.5%, 5%, or 10%, as the case may be, of RFA salary, the definition of RFA salary would be basic salary plus DA forming part plus all taxable allowances plus bonus plus commission, etc. Other than perquisites, you will not take retirement benefits. Then you will be taking the salary which you are receiving from A Limited also and from B Limited also. Got it? So if the assessee is simultaneously working for more than one employer, and during that period where accommodation is provided, you have to take the salary of the entire of all the employers clubbed together. Got it? If more than one accommodation is provided, sometimes it happens that the assessee gets transferred to some other city and he keeps on retaining the old house also, and the new house also is also allotted to him. So first 90 days, first 3 months, assessee has an option. Then they can choose any one house to be taxable. So for first 3 months, if there is an overlapping of 3 months at least, so for first 3 months, any one house would be taxable, any one, which has the lower value, of course. It is on the wish of the employee that whichever the house they want to choose, they can choose that. So obviously, we will choose the value which is lower. So for first 3 months, only one should be taxable. But after 3 months, if both of the houses are occupied by the employee, then after that, both will be taxable, right? So this is also important. If more than one accommodation is provided, please do it accordingly, right? So this is about RFA. And if the accommodation is provided in a hotel, then the value of the perquisite would be actual hire charges of the hotel or 24% of RFA salary. 24% of RFA salary. Whether in new or old, it is same. So it is 24% of the RFA salary, whichever is lower, right? But if the hotel accommodation or any other accommodation is provided for maximum 15 days only. So whenever, let's say, assessee is working in one city, Hyderabad. From Hyderabad, he is being transferred to Bangalore. So for that purpose, for transit purpose, the employer has provided him accommodation for a very temporary basis for maximum 15 days, not more than 15 days. So up to maximum 15 days, it is an exempt perquisite. It is not a taxable perquisite. It will be an exempt perquisite. Got it? And in case that you will not get in the examination, but still, if this employee is a government employee, then in that case, we have to take the license fees. License fees would be provided to the you in the question itself. Then we don't have to consider this. In case of government employee, we have to take the value of the perquisite as the license fees. Correct? Concessional accommodation. If any amount is recovered from you, it will be deducted. So first of all, calculate your RFA salary, RFA perquisite, minus deduct that amount also, whatever the amount is recovered. Got it? Next, this is a little bit amendment which has been came into force, but it is not applicable for previous year 23-24. Why? Because it will not make any difference. What does it say? It says that the value of RFA should not be more than the indexed value of the RFA where it was received in the first year. So actually the first year is previous year 23-24. It is for subsequent year, so that you can safely leave. So even if the question will tell you about some cost inflation index in the question of RFA, it will does not matter to you. Why? Because this is the first year when this thing is brought into picture, and we have to index the value of the RFA for subsequent. It will be helpful in for previous year 25-26, for previous year 26-27. It is not applicable for previous year 23-24, right? Okay. Now the next perquisite is motor car perquisite. See, motor car perquisite is also quite important. Motor car perquisite. If this car is provided by the employer, if the employer has provided this car, what does it mean? Whether either this car is owned by the employer or it is hired by the employer. But it is not your car, it is not employee car. The employer has provided this car. So if it is used for 100% official purpose, if it is 100% official purpose, then it is not a perquisite. The perquisite value would be 0. Why? Because we are not deriving any benefit out of it. It is for 100% official purpose. But if it is for 100% personal purpose, if the car is provided for 100% personal purpose, so see, this personal purpose is always a perquisite because this is your income. This is part of your income. Whatever is given to the employee, that is the income. So this personal portion is your income. So if it is 100% provided to you, then it is your income. Let's say all the expenses are made by the employee only, but the employer has provided you the asset, right? They have provided you the car. So that value of the car should be the perquisite value. So in that case, the value of the perquisite would be, so if it is owned by the employer, 10% per annum of actual cost, not of written down value. It should be for actual cost. And guys, please remember there is a thumb rule. Whenever any asset is provided to you for use, whenever any asset, let's say it is in the case of furnished accommodation also, whenever furniture or any other asset is provided to you, except computer or laptop. If computer and laptop is provided to you, that is a tax-free perquisite. But other than that, any asset is provided to you, then if it is owned by the employer, then we have to take 10% per annum, 10% per annum of the actual cost of that asset. So here also, if the car is provided and it is owned by the employer, we have to take 10% per annum of the actual cost of the car, right? If it is provided to you for 7 months, 8 months, 9 months, please do it accordingly. You can simply do, if it is for 7 months, 6 by 10% per annum into the actual cost of the car into 6 by 12. That you can easily do. So it should be 10% per annum of actual cost, or if it is higher, then you have to take the higher charges. Guys, I'm again repeating, it is a thumb rule. It is a thumb rule whenever an asset is provided to you, either it is owned by the employer, 10% per annum of actual cost, not the written on value, you have to take the actual cost, or the actual higher charges if it is higher. If the employer, it is provided to you for 100% personal purpose, and the employer is also meeting any other expense for it. Let's say fuel expenses, running and maintenance expenses, or driver's salary, whatever the employer is meeting, everything will become your perquisite. Everything should be added, it will become your perquisite. And if any amount is recovered from you, it will be deducted. Any amount recovered, any amount which is recovered from the employee, it would be deducted. Got it? So this is also important. Third is also important, where the car is provided to you. Partly it is employer's car, or employer has provided to you. It is not employee's car, and it is partly for official purpose and partly for personal purpose. That is, it is partly used, partly official, partly personal. In that case, see, generally it is because employer is providing you this car, so generally they will always assure that it should be mostly for official purpose. It should be used mostly for official purpose. But yes, you are allowed to use, for sometimes you can allowed to use for personal purpose also. So here the value of the perquisite would be, so only that personal portion would be taxable. So how much is the value of the perquisite? There they have given a fixed limit. They are saying if these expenses are met by employer, if the expenses are met by employer, and generally this is important, if it's a small car, what is a small car? The engine capacity is up to 1.6 liter cc, 1.6 liter cc, right? It's a small car. Then there is a fixed limit of 1800 per month. And if it is a big car, what is big car? Where the engine capacity is more than 1.6 liter cc, more than one, exactly 1.6, small car. More than 1.6, it's a big car. Then in that case, 2400 per month. It's a fixed limit, right? Even if any amount is recovered from the employee, it will not be deducted. Please don't make a mistake over here. Even if any amount is recovered from the employee, it will not be deducted. It's a fixed limit, 1800 per month or 2400 per month. If driver is additionally provided to you, please increase this limit to 900 per month. Again, for the driver. Got it? Are you able to recall this? Correct? And it is per month. Part of the month should be ignored. Let's say if it is provided to you for 6 months, 7 days, then please ignore 7 days. It is provided to you for 6 months, 28 days, ignore 28 days. 6 months you have to take. So 1800 into 6 or 2400 into 6, whatever the case may be, plus 900 if it is driver also, right? If the expenses are not met by employer, although the car is provided to you, but the expenses are met by employee. The expenses are met by employee. In that case, the perquisite value would be reduced. Why? Because at least only the car is provided, the expenses are met by the employee. So we'll reduce this perquisite value from 1800, we will make it 600 per month for small car. For big car, it is 900 per month. Yes, for driver, again 900 per month, driver or chauffeur, whatever you can say, 900 per month would be included over, right? Expenses are met by employer. But generally, I'm telling you, these are most important. These are most important. But yes, please remember these values also. And if any amount, I'm again repeating, these are the fixed limit. These are the fixed limit. If any amount is recovered from the employee, then it will not be subtracted from these fixed limits. Got it? Okay. One more thing, which is not that important, but still, if more than one car is provided to the assessee, if the more than one car is provided to the assessee, and they are both for personal and official purpose, partly used, then only maximum one car can be taken as partly used, or other car will be taken as 100% personal use. Then you have to take it accordingly. Got it? So this is the motor car perquisite value. This is the motor car perquisite value, car provided by the employer. Then, if the car is owned by the employee, if the car is owned by the employee, so most important thing is, see, if it is 100% official purpose, so obviously there is no perquisite. For official purpose, we don't make it perquisite. Only for personal purpose, if it will make it perquisite. So if it is for 100% personal purpose, then obviously whatever the money which the employer is spending, that will become the perquisite value minus any amount recovered, right? But in case it is partly used, now the car belongs to the employee. Car belongs to the employee, and it is partly used, partly for official, partly for personal. Now, please tell me, the car is of the employee. So generally, he would be using more for his personal purpose. Why? Because the car belongs to him. So what will happen? Any expenses which the employer is meeting, we understand mostly it would be for personal purpose. Why? Because assessee will say, "Sir, this is my car. I will be using it for my personal purpose." Then what we will do, if the employer is meeting any expenses which the employer is meeting, it will be reduced by 1800 per month. Got it? If it's a small car, reduced by 1800 per month. If it's a big car, reduced by 2400 per month. Got it? And yes, if the driver is also provided, then further reduced by 900 per month again, right? So total, I can say, if small car plus driver, so please reduce it by 2700 per month. 1800 plus 900. Got it? So that is also important. Whether the employee can demand that, if sir, more amount can be reduced from it, the if the assessee says that, sir, mostly, although it is my car, but mostly it is used for person, it is used for official purpose, so can I reduce more amount from it, rather than 1800 or 2400? The answer is yes. If he is maintaining specific documents, he is maintaining all the logbook, what is the distance traveled, what is the mileage of the car, if all the documents are getting maintained and they are approved by the employer also, then further subsequent amount, more amount can also be reduced from that. Got it? Next perquisite is domestic servant. If domestic servant is provided to the employee, then in that case, whatever the salary the employer is incurring for that domestic servant, it will become your perquisite minus any amount recovered. Gas, electricity, water bills, all the cost which the company is incurring, the employer is incurring, it will become your perquisite minus any amount recovered. So it could be their purchase cost, it could be their manufacturing cost. Let's say they are giving you gas facility, and the employer is itself is a gas manufacturing company, so their manufacturing cost can be taken, right? Education facility is important. See, if education is provided to the employee, if the education is provided to the employee, then in that case, it is 100% tax free perquisite. So whether that education is 1 day education or it is 1 year, 2 years, 10 years, doesn't matter. So if it is provided to the employee, then it is 100% a tax free perquisite. It is an exempt perquisite. But if it is provided to the family members, then it will become taxable. So whatever the cost of the employer is, it will become taxable minus any amount recovered, right? So if it is provided to the employee's family member, then please make it taxable. So whatever the cost which the employer is incurring. But if the institution is of the employer itself, then we will take the cost, the value which the similar institute charge from other students, then we will take that value. Got it? It will be given in your question. But if the education is provided to the children of the assessee, and that too in the employer's school or college, employer's institution. So if it is provided to the children of the assessee, children means his children, including stepchild or adopted child, not grandchildren. So for children, if the education is provided in employer's institution, employer school or employer college, and the value of the perquisite is up to 1000, so then you can exempt. But if it is more than 1000, then it will be taxable. Got it? So I believe that you got that 1000. And without, and maximum up to two children, no. Here, education facility can be given to more than two children also. So if it is up to 1000, then you can ignore. But if it is more than 1000, please make it taxable. Right? Sweat equity shares, very important. One of the examiner's favorite regarding sweat equity shares. See, whenever the sweat equity shares are given to you, so what are sweat equity shares? These are simple equity shares which are given to the employee. So whatever is the market value of the shares, market value of shares would be your perquisite minus any amount recovered. Any amount recovered. So let's say you are working with some company. For example, you are working with Wipro. So if you are working with Wipro and the market value of the share is 400 rupees, and the company is saying, okay, you can take these shares for rupees 100 each. So 300 rupees would be the value of the perquisite into number of shares, right? 300 into number of shares would be the value of the perquisite. Now, the most important thing is that on which date this market value should be taken. When the offer is given to you, no. When the offer is exercised, yes. When the shares are allotted, no. Only when this offer is exercised by you. So when this offer is exercised by you, that is the date when you are actually claiming this benefit. So when this offer is exercised by you, please take the market value of that date. So examiner will give you three market value. They will give you the market value of the offer date. They will give you the market value of the exercise date. They will give you the market value of the allotment date also. Please here, to make it taxable as a perquisite, please take the market value of the shares as on the exercise date. Got it? If the question paper is little more difficult, on the exercise date, they will give you three values. They will give you opening value. They will give you the opening value of the exercise date. They will give you the closing value of the exercise date. They will give you, let's say, lowest value of the exercise date. They will give you highest value of the exercise date. Then what value you have to take? You have to take, in that case, you have to take the average value of opening and closing. So opening value plus closing value whole upon 2. That's it. Simple average. Opening value plus closing value upon 2. Then you have to take this value. Otherwise, generally, 90% of the cases, they will give you just exercise date value. But still, if the question paper is a little bit difficult, they might give you some different values of the exercise date. Here you have to take only the opening value plus closing value, average value, that is opening value plus closing value whole upon, right? So please remember market value of the share on the exercise date, and average value you have to take of opening and closing. These are sweat equity shares. Interest free or concessional loan. Interest free or concessional loan. See, if the loan is provided by the employer, either at a concessional rate or free of cost. Let's say they are not charging interest from you, free of interest, or at a very concessional rate. Generally, the bank charge, let's say 12% per annum, but your employer is charging just 2% per annum. So whatever the interest which you are saving, that would be the perquisite. Whatever the interest saved, that would be the perquisite. But please remember, if if it is a petty loan means the loan amount is not more than 20,000 rupees aggregate in a year. If it is not more than 20,000 rupees to 20,000 rupees, for that it is tax free perquisite. For that it is tax free perquisite. Second, if the loan has been taken for prescribed disease, for prescribed medical treatment disease like cancer, tuberculosis, etc., then again it's a tax free perquisite. Got it? But other loans are taxable. Other loans are taxable. So in that case, how much it would be taxable? So you have to see the market rate of the bank, market rate of bank minus the interest rate which is charged from your employer. So let's say the market rate of the bank is 12% per annum and interest rate which is charged by the employer is 2%, then 10% per annum is your saving. 10% per annum is your saving. So let's say you have taken a loan of 10 lakh rupees. So 10% per annum would be how much? 1 lakh would be the value of the purchase. Here, the market rate of the bank, which bank you have to take? You have to take SBI bank. Generally, it will not be mentioned in the question. They will simply give you the market rate of the bank is this much. But generally, we have to take the bank rate of SBI, bank rate of SBI. But the bank rate of SBI might change during the year. So what we have to take? We have to take the market rate of the bank on the first day of the previous year when the loan was taken. So on the first day, they will not ask you this much, but still it is on the first day of the previous year when the loan is taken. So when let's say the loan is taken somewhere in previous year 23, 24. So on the first day, what is the bank rate? On 1st April 23, what was the bank rate? You have to take that rate only. Got it? And only for the purpose for which you have taken the loan. If this loan is taken for a vehicle loan, you have to take the vehicle loan interest rate. If that is taken for a home loan, you have to take for the home loan interest rate, right? So in the first day of the year, it is 10% per annum. I'm assuming that the 10 lakh loan is outstanding for the entire year. Let's say the 10 lakh loan is outstanding for 6 months, 8 months, 9 months. Please calculate it accordingly for those months only, right? If the balance is getting changed, let's say every month you are repaying something, then in that case, you have to see whatever is the closing balance of each month, whatever is, then you have to calculate this interest saving for each month. Then you have to see that whatever is the closing balance of each month, please calculate that interest rate on that closing balance. Got it? But generally, in examination, they will give you that 10 lakh rupees the loan which you have taken for the entire year, or for 6 months, 7 months, 8 months, then you have to calculate it. Got it? Okay. Food and refreshment facility. Food and refreshment facility. If you are getting refreshment facility, refreshment is tea, coffee, etc. That is exempt perquisite. That is an exempt perquisite. But meal facility, lunch or dinner facility, it is a taxable perquisite. In default regime, please make it fully taxable. Under default regime, please make it fully taxable. But under optional regime, maximum up to 50 rupees per meal can be exempt. So in optional regime, see, refreshments are fully exempt. Refreshments are fully exempt, but meals, your lunch or dinner, would be taxable. How much? It would be for default regime fully taxable, but in optional regime, let's say it is 75 rupees per day meal you are getting per day. So if it is optional regime, so minus 50 rupees per day, you can minus subtract 25 per day would be taxable. And you can take the number of days, either it will be given to you, otherwise the number of working days you can take. Please don't take 365 days, because we don't go to the office 365 days. You can take 300 days. Otherwise they will give you, if they will not give you, please take the number of days as 300. Got it? Gift from employer. See, if it is monetary gift, if it is cash gift, they are giving you check, etc. If it is cash gifts are fully taxable. Whether it is more than 5,000, less than 5,000, doesn't matter. Cash gifts are like bonus, so these are fully taxable. But if the gifts are in kind, and the aggregate value of this gift is up to 5,000 rupees, if it is up to 5,000 rupees, then they are exempt. But if it is more than 5,000 rupees, then they are taxable. So now you have two options. Let's say total gifts which you have received is 8,000. It is more than 5,000. So you have two options. Either you can make it fully 8,000 taxable. Second alternative is you can just subtract 5,000. You can make 3,000 taxable also. Both are correct. So institute will give you marks under both the alternatives, right? So either you can make it fully taxable, or you can subtract 5,000 and make the remaining in excess of 5,000, then only taxable, right? My recommendation, make it fully taxable. Use of movable assets. I've already told you that it's a thumb rule. Whenever the asset has been given to you for use, you can use it. Till you are an employee, you can use it. After that, you have to give it back. So in that case, 10% per annum of the actual cost, not the written value. It should be of 10% per annum of the actual cost. But if the computer or laptop has been given to the assessee, to the employee, it is a tax-free purchase. So for use of asset, it is 10% per annum of the actual cost. And if it is hired by the employer, then you have to take the actual hire charges. Got it? These are the perquisite. If any amount is recovered from you, please subtract that amount also. Got it? If this is important, if we transfer any asset to you, if you purchase the asset from your employer, and that too at a concessional value, if you purchase any asset from the employer, they are permanently selling it to you. So in that case, let's say there is a computer, let's say company has a computer, they have used it for 1 or 2 years. Let's say for 2 years they have used it, this computer. They have purchased this computer for 50,000. For 2 years they have used it. Now they are selling it to you. Now you have an option. Either if you want to purchase, you can purchase it. They will give you at rupees 6,000 rupees. So whether it's a perquisite, yes, because we are getting at a concessional value. So how much is the perquisite value? First of all, you have to calculate the depreciated value of this computer. Calculate the depreciated value of this computer minus the recovery which is being made from you. That would, let's say the depreciated value of this computer, for example, the depreciated value of this computer comes to 15,000. Randomly, I'm saying that's 15,000. So 15,000 minus 6,000, 9,000 would be the requisite value. Got it? Now, how we will be calculated? How we will be calculating the depreciated value? See, in case of computers and laptops, etc., the depreciation rate is 50%. In case of salary, see, in PGBP we apply 40% rate, but in case of while computing the perquisite, you have to apply 50% depreciation rate for every year, computer or laptop. If it is cars, then 20% is the written down value. In PGBP, we have 15% rate. But guys, that is for charging depreciation. Here we are computing the perquisite value. So for car, it is 20%. For other assets, it is 10%. Apply this depreciation rate. But please remember, in case of computer, laptop, or car, it should be by written down value method. But for other assets, it should be straight line method. Got it? So in these two cases, it is WDV method, and here it is SLM method. And now, for every completed years, you have to compute the depreciation. So if the employer was using it for 2 years, 3 months, just ignore 3 months, calculate the depreciation of for 2 years and calculate the depreciated value, right? Part of the year shall be ignored. You have to take only completed years. From where you will be starting your number of years. See, when this asset was put to use, when this asset was put to use by the employer, till it is sold to you, just see the number of years. And if it is completed years, then it's okay. But if it is completed plus some months, etc., then please ignore that months, only take completed years. Got it? So this is quite important for you. So transfer of movable asset for computer, mobiles or storage devices, it is 50%. For cars, it is 20%. For other assets, it is 10% straight line method. Got it? Okay. Leave travel concession. See, LTC, if you are following default regime, and the person is getting LTC, it is fully taxable. LTC is fully taxable, but in optional regime, it is exempt. How much it is exempt? See, if the mode of travel is by air, then economy class airfare is exempt. But if the mode of travel is by any other mode, other than air, it is any other mode, then we will see that if the train is available wherever the assessee has traveled, whether the train route is there or not, if the train is available, then we will take the first class rail fare. If train is not available, but any other recognized system is available, then we will be taking the deluxe fare of that class. If there is no such transportation system available, neither the train is available nor any other mode of transportation recognized is available, then we will see what would be the deemed rail fare value. We would be exempting it, right? So we would be exempting it, and LTC can be availed only in 2 years out of the block of 4 years. This is not that so important for your examination purpose, but yes, it is available only for 2 years in a block of 4 years. Second thing is that if the children are born after 1/10/1998. If they are born before that, then the number of children are allowed, any number of children. But if they are born on or after this date, then only maximum 2 children are allowed, right? If maximum 2 children are allowed. Then medical facilities, very, very important facility. If medical facility, let me explain this. See, if it is medical allowance is fully taxable. Medical allowance is fully taxable. But if it is medical facility, medical treatment, if the treatment is in employer hospital or government hospital, it is employer hospital or government hospital, then for any disease it is exempt. And if it is for other private hospital, but it is a notified hospital, it's a prescribed, it's a notified hospital, and that too for prescribed disease. for prescribed disease, then only it will be exempt. Second thing is that health insurance policy. Life insurance is taxable, but health insurance policy premium, which is paid by the employer, it is exempt, right? So please remember employer hospital, government hospital, any disease, notified hospital, prescribed disease like tuberculosis, cancer, etc., and health insurance premium are exempt. But that is only for the assessee and their family member. Who are the family member? Spouse and children. Whether they are dependent, whether they are non-dependent, both are covered over here. Parents are also covered. Brother and sister are also covered if dependent, right? So any other person who is getting treated, let's say father-in-law, mother-in-law is getting treated, cousin is getting treated, please make it fully taxable. In here also it will be taxable. They are exempt only when the treatment is for the self of the employee or their family member, and these are the family members. If father, mother, brother, sister is not dependent, they will not be counted as the family member for this particular purpose. Got it? This was easy. Treatment outside India not so important. Okay, fully exempt perquisite. See, telephone and computer facility. Telephone facility is fully exempt perquisite. Computer or laptop, if it is provided to you, it is a fully exempt perquisite. Accommodation to High Court or Supreme Court judges under optional regime, it is an exempt perquisite. Foreign allowances. If there is an Indian citizen who is posted abroad and government of India is paying him salary, you understand Section 9, income deemed to arise in India. So if this Indian citizen is posted abroad, then government of India is paying salary to him. It is that income which is deemed to arise in India. We make it taxable. But only basic salary would be taxable. Foreign perquisite, foreign allowances would be exempt, right? Cab facility from home to office. Cab facility from home to office shall be exempt. Okay, one more thing which I missed is transport allowance. Transport allowance, if the transport allowance is a personal allowance from home to office, that is an allowance. It is a part of your salary. From home to office and office to back. It is a taxable perquisite. It's a personal allowance and it's a taxable perquisite. Got it? Second thing, if the assessee is physically handicapped, blind, deaf, or dumb, in that case, it is exempt up to 3,200 per month under both the regimes. Got it? Health insurance premium is exempt. Recreational facility. Let's say we are taking our employees for a movie, we are taking our employees for team lunch, etc., or for outing, etc., for 1 day, 2 day, 3 days. That would be an exempt perquisite. Or accommodation provided in a remote area or a mining site, etc., that is also exempt, not so. Got it? Next point is about retirement benefits, gratuity, pension, leave, salary, etc. So how they will be taxable? Provident fund, again an important retirement benefits. So how you will be treating these gratuity, etc. See, if the gratuity is getting to the employee during the tenure of his service, every year this person is receiving gratuity. That gratuity is always fully taxable. Correct? So gratuity received during the tenure, it is fully taxable for all the employees, including government employees. Let's say if your question says that this person is receiving, let's say 1 lakh rupees per annum gratuity, that is fully taxable. But in case the gratuity is received at the time of retirement or resignation, that is when the employee is leaving the organization at that particular point of time, this person is getting the gratuity, then it could be exempt up to a certain limit. If it is government employees, central government, state government, or local authority employees, for them, this gratuity which is getting at the time of retirement, that is retirement means termination, resignation, etc. So if government employees are getting, it would be fully exempt gratuity, right? But mostly in examination, you will not get government employee. It would be non-government employee. If the non-government employee is getting gratuity, so first of all, examiner will tell you that whether it will be in the question paper that whether this person is covered under Gratuity Act or not covered under Gratuity Act. 99.9% it will be given to you that whether this person is covered or not covered. If this person is covered under Gratuity Act, then least of the following will be exempt. How much? Actual gratuity or rupees 20 lakh. 20 lakh is the fixed limit. Actual gratuity 20 lakh rupees. 15 by 26. Please remember the person who are covered under Gratuity Act, it would be 15 by 26 into their last drawn salary into completed year of service or part thereof in excess of 6 months. That should be rounded off. So let's say it is 26 years, 7 months. So please make it 27 years. Got it? So please remember 15 by 26 into last drawn salary. What you have to take in last drawn salary, it would be basic salary plus DA. Whether it forms part of retirement benefit, whether it does not form part of retirement benefit does not make sense, does not make any difference. So it would be basic salary plus DA. Got it? So if this person is covered under gratuity. See, if this person, I'm again repeating, this person is a central government, state government, or local authority employee, it would be fully exempt at the time of retirement. But for other employees, if they are covered under other employees, means non-government employee. If they are covered under Gratuity Act, then least of the following would be exempt. Please, 20 lakh. Remember, this is the fixed limit. If this person, if your question says that the person is not covered under Gratuity Act, it is quite similar. Only the last portion, the last limit is changed. Actual gratuity received or rupees 20 lakh, or there you were taking 15 by 26. Here you will be taking 1 by 2. 1 by 2 into average salary of the last 10 months and only completed year of service you have to take. That is, if this person has worked for 30 years, 11 months, you will be taking only completed years. That is 30 years only. Got it? Average salary of last 10 months. And what should salary include? Salary should include basic salary, DA forming part, plus fixed percentage commission on turnover. That is retirement benefit salary. Got it? So this is how you will be computing gratuity. I'm again repeating. If the gratuity is received during the tenure of the job by any employee, even government employee, if it's receiving regular gratuity, it would be fully taxable. But at the time of retirement, then it would be exempt. Got it? If your question paper says that this person is not a government employee and they will not tell you, only 1% case would be there. They will not tell you that whether this person is covered under gratuity or not covered under gratuity. Then you can take your own assumption. You can take your own assumption. I would suggest please take this assumption that this person is covered under gratuity. Got it? Second is pension. See, if the person is getting regular pension, let's say 5,000 per month, 10,000 per month, it is taxable for all the employees, whether it is government employee, whether it is non-government employee, it would be fully taxable. Regular pension is fully taxable for all the employees, which we also call it uncommuted pension, right? So let's say if in your question, let's say it's a total income question, and this person is running a business also, there is a PGBP income. Side by side, this person is retired and getting pension rupees 10,000 per month. So 10,000 per month, please make it salary income and give standard deduction also. Correct? So regular pension is fully taxable. But if the pension is received at the time of retirement or resignation, then it could be exempt up to a certain limit. If these are government employees, then commuted pension. What is commuted pension? The lump sum pension which you receive at the time of retirement. If it is a government employee, it is fully exempt. If it is a non-government employee, then it is partially exempt. How much it is exempt? It depends that whether the employee has received gratuity or not. If the person has not received gratuity, we will give him more exemption. If the person has not received gratuity, we will give him less exemption. So how much exemption we will give to them? So whatever is the commuted pension received. So first of all, write whatever is received over there minus. If the person is a government employee, fully exempt. Correct, fully exempt. If the person is a non-government employee, then see whether this person is receiving gratuity or not. If the person is not receiving gratuity, 1 upon 2 of the pension, with the commuted pension divided by percentage of commutation. Percentage of commutation means, let's say this person is saying that 80% of the pension is commuted, 90% of the pension is commuted. So divide by 80%, 90% as the case may be. Correct? And if this person is receiving gratuity also and commuted pension also, so we will give the exemption little less. How much? 1 upon 2? No. In this case, 1 upon 3. 1 upon 3 is a lower amount. Correct? So if this person is not receiving gratuity, the exemption would be 1 upon 2. Otherwise, if this person is receiving gratuity, the exemption would be 1 upon 3 into commuted pension divided by the percentage of commutation. I'm again repeating, if it is uncommuted pension means regular pension. Regular pension is always fully taxable even for government employees. Next, provident fund. See, if this provident fund, generally, mostly they will tell you about the recognized provident fund. So in your question, it will be written that the employer and the employee both are contributing towards recognized provident fund. So whenever you will be writing all your components, basic salary I'm getting, DA I'm getting. So please also add employer contribution. Employer contribution to recognized provident fund, right? Whatever the employer is contributing, whatever is the employer is contributing, write this amount, employer contribution. See, employee contribution is not salary. Employee contribution is an investment, right? It is actually my own amount which I am contributing over there. That is not salary income. Only the employer contribution is salary income. So let's say if this person is receiving basic salary, this person is receiving DA, this person is receiving any other allowance. Side by side, this person is receiving employer contribution to recognized provident fund. First of all, write this amount, less exempt, less exempt. How much would be exempt? This is important. See, if it is not RPF, if it is SPF, very little chances are there that it would be SPF. But if it is SPF, then it is fully exempt. It is fully exempt, nothing is taxable. Got it? Employer contribution to statutory provident fund is fully exempt. But if it is RPF, it is exempt up to, see, it is least of the following. First is actual contribution by the employer. Second is 12% of salary. 12% of salary. And here salary means retirement benefit salary. Retirement benefit salary, what does it consist of? Three things: basic salary, DA forming part of retirement benefits, plus fixed percentage commission on turnover, right? So most important it is that up to 12% of the salary is exempt. Correct? And third and very important, if this person is earning little high salary, then there would be a limit of 7,50,000 also, 7.5 lakh also, right? Whichever is lower would be exempt. So employer contribution to RPF is exempt. Generally, we say it is up to exempt up to 12% of the retirement benefit salary, but it is actually actual contribution by the employer, 12% of retirement benefit salary, or 7.5 lakh rupees, whichever is lower, that would be exempt. And in excess of it, please make it taxable. Got it? And also interest on employer contribution. Interest on employer contribution to RPF, it is whatever the amount which you are getting, it will be salary income, but it is exempt up to 9.5% interest rate. If the interest rate is more than 9.5%, then only please make it taxable. But if it is up to 9.5%, please make it exempt. Got it? If it is URPF, guys, if this contribution is unrecognized provident fund, for unrecognized provident fund, please don't make it taxable every year. URPF amount is not taxable every year. It is taxable only at the time when the person is actually receiving this amount. So unrecognized provident fund. So let's say this is unrecognized provident fund. It is not taxable every year. First of all, it is taxable only at the time when the person is actually, because see, it is unrecognized, because you never know whether you will be receiving this amount or not, because the employer is contributing it in unrecognized. It is not regulated by any government authority. So you are not sure whether you will receive it or not. So it will be taxable only in the year when you will actually receive it. So it has actually four parts. It has actually four parts. Whatever is the employer contribution when you receive, plus interest on employer contribution, interest on employer, I'm saying employer contribution. These two parts will become your salary income at the time when you will actually receive it. So employer contribution, interest on employer contribution, that would be salary income at the time when you will actually receive it. And the amount which is related to employee contribution. Employee contribution, this is not taxable. Why? Because it is part of your salary. It was part of your basic salary, D, etc. So it was already taxable during the year. It was just an investment. It is not taxable. But the interest on employee contribution, interest on employee contribution, it is taxable as IFOS income. Again, I am repeating. Let's say at the time of retirement, person received the URPF balance. For example, the URPF balance is 12 lakh rupees. How this 12 lakh rupees is constituted? Let's say employer contribution is 4 lakh, employee contribution is 4 lakh, and this is 2 lakh rupees, right? Total 12 lakh rupees he is receiving. So this employer contribution plus interest on employer contribution, 6 lakh will become salary income at the time when he is actually receiving it. 4 lakh, it is employee contribution amount. This is not your income, right? This is not taxable, but interest on employee contribution would be IFRS. Got it? This is how you will be dealing with provident fund. Last and important is leave salary. If you will receive leave salary, see if what is leave salary, you all understand. For the leaves which you can take, the earned leaves which you can take, if you have not availed it, you will get this money. So if you are getting this leave salary every year, it is regular leave salary. Every year, if you are getting it, it is always fully taxable. Let's say every year the employer gives some salary, some leaves to us, but we don't avail it, and every year they keep on giving me the money. So in that case, it is fully taxable. But if this leave salary we are getting at the time of retirement, at the time of resignation, that it is exempt up to a certain limit. Again, if it is government employee, if it is central government or state government employee, then this leave salary is fully exempt. If it is central government or state government employee, leave salary is fully exempt. But in case the employee is a non-government employee, then least of the following would be exempt. What is the least? Actual leave encashment, actual leave salary, or 25 lakh rupees. Fixed limit is 25 lakh rupees over here. So A, actual leave salary, B, 25 lakh rupees. Third, 10 into average salary. 10 into average salary. And what is the average salary over here? Salary here includes basic salary, DA forming part, plus fixed percentage commission on turnover. And what is the average? For the last 10 months, before the date of retirement, whatever is the last 10 months, please take the average of it, right? So 10 into average salary, into leaves at the credit, into average salary. But maximum, what is leaves at the credit? What are the leaves which you have not availed? What are the leaves which you have not availed? That is called leaves with the credit. See, let's say if this person has worked for 25 years, this person has worked for 25 years, and every year we were giving them 28 days of leaves, 8 days of leaves, right? And let's say every year this person is taking 10 days of leaves. 10 days of leaves was availed by him. And let's say 2 days leaves are encashed by him every year. So every year, actually, in his bucket, 28 leaves we are granting him. The company was granting 28 days leaves. 10 days leaves he was availing every year. 2 days leaves he were encashing every year. So what is the remaining amount? It would be, I believe, 16 days. So 16 days would be the leaves unavailed. This is the leaves unavailed. These are called leaves with the credit. And for how many years he has worked? 25 years. So it would be 16 days into 25. This is the number of days, right? Please compute this in month. Please just convert this days into months. So how you will be computing it? Divided by 30. This is called leaves at the credit. It should be in months. Why I divided it by 30? Because it should be, because 16 days every year for 25 years, it would be 16 into 25 days. Just divided by 30. This is called leaves at the credit into average salary. And what is average salary? Basic salary, DA forming part, plus fixed percentage commission on turnover of the last 10 months. Correct? So just multiply by this, you will get this last amount. So whatever is least of the following, you have to take that. Actual leave salary, 25 lakh, 10 into average salary, leaves of the credit in months. In months, please divide by number 30. You will get leaves in months into average salary. Got it? Please remember that if the employee is giving us 28 days leave, 29 days leave, 30 days leave, then it's okay. But the employee, if this employer is giving us more than 30 days leaves, let's say this person, the employer is giving us 45 days of leaves, then what would be the leaves of the credit? Should I subtract 48, 45 minus 10 minus 2? No. In that case, maximum leaves granted should be taken as 30 only. Maximum leaves granted. So if the employer is giving us 30 up to 30 days of leaves, then it's okay. But if the employer is giving more than 30 days of leaves, then only please take maximum leaves granted as 30. Don't take 45, take 30. 30 minus 10 minus 2, let's say 18 days leaves we are getting every year. Into, for example, we have worked for 25 years into 25. If we have worked for 25 years plus some months shall be ignored. Only the complete year should be taken out. Got it? So this is leave salary. Then voluntary retirement and retrenchment is not so important, but still let me quickly revise them also. VRS, if the person is getting a VRS and he is receiving a lump sum amount on his voluntary retirement, so this could also be exempt up to a certain limit. What is the limit? Actual amount received on VRS, or rupees 5 lakh, or 3 into salary into completed year of service, whatever the years which he has worked for into completed year of service. So 3 into salary. Here salary means basic salary, DA forming part plus fixed percentage commission on turnover, right? And the fourth is last drawn salary. Salary here means this salary, basic salary, DA forming part plus fixed percentage of commission on turnover into remaining months of his service left. What is remaining months of service left? Let's say he is getting VRS at 55 years of age, and generally the retirement age is 60 years. So what is the remaining years left? 5 years. 5 years into 12 months, so it would be 60 months. So remaining months of service left would be 60 months. Got it? 5 years which are left into 12, that is 60. So last drawn salary into 60 months. So list the following in VRS. VRS is not that important, but still if it comes, please remember actual amount of VRS received 5 lakh, 3 into salary into completed years into last drawn salary into remaining months of services left. Second, if the assessee is getting retrenchment compensation, it is almost quite similar. So retrenchment compensation fixed limit is also 5 lakh rupees. So actual compensation of retrenchment compensation or rupees 5 lakh, and third is 15 by 26 into average salary into complete year of service or part thereof in excess of 6 months. Got it? Not so important, but still, if it comes, please do remember one thing, that the maximum amount here is, and VRS is 5 lakh rupees. Got it? Okay. Now let us come to our next topic, that is house property. See, house property is very, very easy. Please try to grab maximum marks in house property question. If you will get it, generally examiner asks for house property also. Please try to grab maximum question marks over here. See, first of all, how is house property income computed? First of all, you have to compute GAV, gross annual value. This GAV minus municipal taxes paid. This amount, you will get NAV, net annual value. From net annual value, you have to subtract only two deductions, 24A, 24B. Even if you don't remember the section number, it's completely fine. But please remember that there are two deductions only available from house property. 24A, that is 30% of NAV. 30% of NAV. And second is interest on borrowings. Interest on borrowings, right? So just subtract these two, you will get your house property income. This is a fixed format. Always remember that this is the fixed format of house property. If the house is self-occupied entire year, if 100% the house is self-occupied, you have to take the NAV as nil. You have to take the NAV as nil in case of self-occupied property. You will not start from GAV. You will not deduct any municipal taxes. You have to start. For self-occupied property, your starting point should be NAV. NAV nil. 24A is 30% of nil would be 0. 24B, interest on borrowings. Interest on borrowing. Now it depends, because now there is a difference in optional regime and default regime. If the person is following default regime, he will not get deduction of 24B also in case of self-occupied property. So only in case of self-occupied, there is a difference in default regime and optional regime. I'm repeating. So please remember, in case of self-occupied property, your starting point should be NAV nil. 24A deduction, 30% of nil would be 0. 24B, interest on borrowing in default regime, it is again 0. So your house property income under default regime, in case of self-occupied, it would be 0 under default regime. Understood? But if it is an optional regime, NAV of self-occupied would be nil. 24A standard deduction, 30% of NAV would be 0. Nil into 30% would be 0. 24B is maximum 2 lakh or 30,000 as the case may be. So this is the deduction which you can get. So interest limit is, the interest is limited up to 2 lakh rupees or 30,000 rupees, right? When you have to apply 2 lakh, when you have to apply 30,000 rupees, if the loan is borrowed, if you have taken the loan only for the purpose of construction or for purchase of the house, I'm again repeating, for acquisition or construction, then 2 lakh rupees you have to take. Otherwise, in all other cases, please take 30,000 rupees. So if you have taken the loan for repairs, renovation, reconstruction, etc., then 30,000 would be the limit. I'm telling you only in case of house for self-occupied property. In case of let out property, there is no such limit. But first, let me discuss with you the self-occupied portion. So if the property is self-occupied, in case of default regime, obviously the income would be zero because there is no 24A, 24B, be zero again. In case of optional regime, NAV would be nil. 24A standard deduction would be 30% of nil would be zero, of course. But 24B interest on borrowing is limited either 2 lakh or 30,000. In case of purchase of the property or in case of construction of the property, please take 2 lakh rupees as the limit. In other cases, please take 30,000 as the limit. Got it? So this was a difference in default versus optional regime. Now, let me talk about let out property or deemed let out property. If the property is let out or deemed let out. So here you have to first start with your GAV. Generally, mostly 90% cases, your GAV is your actual rent. Your GAV is your actual rent. Mostly they will give you just the actual rent. So actual rent would be your GAV generally in most of the cases. But if you ask me technically, so what? How is GAV computed? GAV is expected rent or actual rent, whichever is higher. Expected rent or actual rent, whichever is higher. 90% of the cases, they will not give you any information regarding expected rent. Only they will give you the information about actual rent. So you have to take. So this is what I was saying, that generally your GAV is actual rent. But in case if they give you information regarding expected rent, so please first of all compute your expected rent. How is expected rent computed? First of all, you have to compare the municipal value or fair rental value, whichever is higher. First, this value would be the expected rent. But if standard rent is also available, then whatever is the higher, compare it with standard rent, whichever is lower. That would be your expected rent. So expected rent is municipal value or your fair rental value, whichever is higher, compared to standard rent, whichever is lower. That would be your expected rent. Mostly in I would say not more than 5% cases would be there. Then expected rent you have to calculate. Otherwise, they will not give you any information regarding expected rent. So forget about expected rent. Just calculate your GAV by taking your actual rent. Got it? So GAV would be your expected rent or actual rent, whichever is higher, mostly actual rent, minus municipal taxes paid. These municipal taxes which are paid during the previous year only. If you have not paid it, you will not be getting any deduction. So they should be actually paid. I can say it would be allowed only on payment basis, on cash basis. Cash basis means if it is only paid during the previous year. Up to the due date of ROI, no. Due date of ROI is PGBP concept. Here, if it is paid during your previous year 23, 24, then only it will be allowed. During this 365, 366 days, if it is paid, then only it will be allowed. Otherwise, it will not be allowed. Second thing, it should be paid by the landlord. The owner should be paying it. If any other person is paying it, tenant is paying it, you will not get deduction. The deduction would only be available if the owner has paid it. So after deducting municipal taxes, you will get your NAV. 24A, 30% of that NAV would be there. 24B, whatever is the interest, you will be getting it without any limit. For let out or deemed let out property, there is no such limit. It was only in case of self-occupied, there is a limit only under optional regime. In default, we will take it zero. So in let out, for let out property, there is no limit. Got it? Now, let us more focus on this interest on borrowing, 24B. See, this is 24B, this deduction on interest on borrowing, interest on loan. How you will get this deduction? This interest comprises of two things. First of all, your previous year 23, 24, this is your year, correct? This is your year for our examinations, January 25. So whatever is the interest which is due during this period, that is, I can say current year interest. I can say current period interest, current year, right? So whatever is the current year interest, you have to take this. 24B is first of all current year interest. So whatever is your loan outstanding during this year, if the loan is entirely outstanding for entire 12 months, please calculate the 12 months interest. If the loan is outstanding, let's say not for 12 months, it is less than this year, you have already repaid it. So whatever is the outstanding balance of the loan is for whatever the number of months, number of days, please calculate that interest. So first of all, the current year interest. Second, Second would be the pre-construction period interest also. Pre-construction period interest also, and it should be taken as 1/5 because you know that pre-construction period interest is allowed in 5 equal installments, right? And in the first 5 years, whenever the house is constructed in that year plus next 4 years, that's total 5 years, you will get this particular interest. So this total is called 24B. This total is called 24B, current year interest plus 1/5 of pre-construction period interest also, in case your year is in the first 5 years of from the date of construction. Got it? Now, how is pre-construction period is computed? See, first of all, whenever you take the loan, date of loan, start your period from the date of loan till your actual construction date, till your construction date. So let's say, for example, construction date is 15th of June. Let's say the date of loan is 1st January 2019. This is the date of the loan. And the construction was completed, for example, on 15th of June 2022. Got it? So first of all, you have to see that the construction is getting completed in which previous year. In which previous year? So this date belongs to which previous year? So this date belongs to previous year 21-22. Got it? No, this is 22-23. This is 22-23. This date belongs to previous year 22-23, right? So before this previous year, that is only up to the date which is related to pre-construction period. So what you need to do is this previous year starting from 1st April 22. 1st April 22, the previous year starting, just go before that. So before that, if I'll go, it would be 31st March 2022. Got it? So you don't have to take this previous year any day. Don't take any day of this previous year. Just go back to 31st March before this. So before this, 31st March was 31st March 2022. So from 1st January 2019 till 31st March 2022, this is your pre-construction period. And you have to compute the interest for this particular period, which is allowed in 5 equal installments. Correct? If the loan is same during this period, you can safely compute the interest divided by 5. If the loan amount is changing during this period also, so please be very careful about it. So if the loan amount is changing during this period also, please calculate your interest accordingly and just divide it by 5. Correct? And this interest will be allowed in first 5 years, starting from this year. So previous year 22-23, previous year 23-24, and so on. Total 5 years it will be available. If our year is not part of those 5 years, the 5 years have already expired. Now we will not be getting any pre-construction period interest. So pre-construction period interest is only and only available in first 5 years. Got it? So this is more about house property. Second thing, if your house property is situated outside India, then it could be taxable. Yes. If it is ordinary resident, then it is, you understand, for ordinary resident, global income is taxable. But in case of this person is a non-resident or a not ordinary resident, in case if it is received in India, then it would be taxable. Then how you have to do it? If it is from this property situated outside India and you are making it taxable, just calculate everything in foreign currency. Just calculate everything in foreign currency. Calculate GAV, municipal taxes paid. Even the municipal taxes paid outside India, that is will also be allowed. So municipal taxes paid, NAV 24A, 24B. This house property you will get in foreign currency. Just multiply it by or accordingly convert it to Indian rupees. You will get your house property income of the foreign currency in the Indian rupees also. Next type of question which you can get, let's say there are one property. Let's say there is one property and part of the property is let out, part of the property is self-occupied. Let's say half of the property is, one floor is let out and one floor is self-occupied. So in this case, please take your each individual unit as a separate property. So what you have to do is just make two columns. One is for let out, other for self-occupied. Right? We start with GAV minus municipal taxes minus NAV, etc. See, for self-occupied property, GAV and municipal taxes would be of no use. We'll start with NAV. For self-occupied, NAV is nil. 24A standard deduction would be 0. 24B, it depends which regime you are following. If it is default, then there would be no deduction. If it is optional, then maximum 2 lakh or 30,000 as the case may be. Got it? But for let out property, compute your GAV first. If you are computing your GAV for the entire house, please divide it by 2. Let's say I'm presuming that it is equally distributed. So please, everything, municipal taxes, if you have paid for the entire house, please take it only for that particular portion which is related to let out property. So I'm assuming it is one floor. So it is equally distributed. So it should be 50-50%. Got it? GAV would be 50-50%. Interest should be 50-50%. Got it? So it depends. So let's say your question says that 75% of the property is self-occupied, 25% is let out. So everything here you will be taking for 25% only. So please do it proportionately. This is the second type of question which you can get in a house property. So house property is quite an easy concept. Please don't make a mistake over there. Right? So this was all about house property. Also, one more thing. If you will get arrears of rent, or you will get recovery of unrealized rent, this will become your house property income in the year when it is recovered. In the year when it is recovered, it will become your house property income. Whether you have the house in this year or not doesn't make any difference. So arrears of rent or recovery of unrealized rent will become your income. But please give 30% standard deduction. Only 70% of that amount which you have received, which you have actually received it, please make it your house property. Got it? So this was about house property. Let us come to PGBP. See, we understand that in PGBP, we have section from 28 onwards till 44. So from 28 till 44, we have PGBP, and section 28 is a charging section for PGBP income. It says that what are the types of income which can be taxable under PGBP. So first point says that if there is any business, any profession, that business can be legal, illegal, doesn't matter. So in case of any business, any profession carried by the assessee at any time during the previous year, so it's not necessary that the assessee should carry this business for the entire 12 months. No, even part of the previous year, if he is carrying the business, then it's okay. So that would be PGBP income. Second, and most important, gifts or perquisites which we receive. See, gifts are generally taxable under IFOS. But if the gifts are received from employer, that will be salary income. But if the gifts or perquisites or other facilities are received in the course of our business and profession from our clients, from our customer, etc., so it will become our PGBP income. So please remember, gifts in the course of business or profession is our PGBP income. Non-competing fees is our PGBP income. Some received from a key man insurance policy. See, if the key man insurance, so that particular person who is a key man, if that person receives the money, that is his salary income if he is an employee. Or if the business receives this money, it will become their PGBP income. Or if any other person receives this key man insurance amount, that will be in IFOS. So we refer this key man insurance policy in 3 chapters: salary, PGBP, and IFOS. So it depends upon who the person who is receiving the money. If the business is receiving this money of key man insurance, it will be their PGBP income. Inventory converted into a capital asset. If you convert your stock into your capital, see, capital asset, when it converted into stock, then there is a capital gain income which will arise. We'll be seeing in the next chapter. But whenever the stock is converted into capital asset, the day on which it is converted, whatever is the fair market value, will become your PGBP income, right? Remuneration received by a partner from the partnership firm. So if the partner is receiving any remuneration, it could be interest on capital, it could be salary, bonus, commission, etc. If they are receiving, it will be their PGBP income. But please remember, whenever the interest is received, interest received by partner from partnership firm, up to 12% only will be PGBP income. In excess of 12%, it will not be PGBP. So interest on capital only up to 12% only would be the PGBP income. In excess of 12%, you know that it will not be allowed in the hands of partnership firm itself. So for the partner, please make it only 12%. Whether this person is a working partner, non-working partner, interest on capital is taxable in the hands of the partner, maximum up to 12% rate of interest. Other remuneration, salary, bonus, commission, etc. If a working partner is receiving, then it will be their PGBP income. If a non-working partner is receiving, it will not be their income, right? In fact, it is not allowed in the hands of the firm itself. So whenever a working partner will receive salary, remuneration, or any other amount from the partnership firm, then it will be their PGBP income. Got it? Export assistant, your cash assistance, your export incentive, Sale of import entitlement license, this is all PGBP income. Compensation on breach of a business contract, that is PGBP. And whenever you will sell your 35 AD asset, what is 35 AD? That is for a specified business, that 14 specified business. Whenever you will sell your assets, that will also be your PGBP income. Got it? Most important are gifts received from in the course of business and remuneration received from the partner. These are something which is most important for examination purpose. Okay. So this was section 28. Next section is 29. 29 is computation of PGBP. How we will be computing our PGBP income. See, first of all, generally, whenever you will be getting your question, basically your total income question. So your total income question would be like this. There would be a mostly your P&L account or income and expenditure account will be given to you. Correct? And you have to compute your total income. Right now, I'm more concerned with my PGBP income. So here it would be some expenses, here it would be some income, and let's say here would be your net profit, right? Net profit or net loss as the case may be. So this should be your starting point. Whenever you will compute your PGBP, see, whenever we are computing our PGBP income, so we are more concerned with only with PGBP. We are concerned with PGBP expenses. We are concerned with PGBP income, right? So my first step should be net profit as per P&L account. Net profit as per P&L account should be my first step. So whatever is the net profit, in case of loss, you can write this as a negative figure. That is not a problem. So for your first step should be the net profit. Your second step, look at all your expenses side. Look at all your expenses side. Only the expenses which are business expenses, which are allowed under section 30 till 37, that are only allowed, right? So only those expenses are allowed. If there is any expense which is specifically disallowed, let's say you have made a cash payment, you have made a payment to a related party in excess of fair market value, you have made a cash payment in more than 10,000 rupees, then it will be disallowed. Or any expense which is not allowed under section 30 till 37, it will not be allowed. You have made a donation to Prime Minister Relief Fund, etc. Although we know that in 80G there might be a deduction available, but as a business expense, it is not a business expense, right? So whatever is not a business expense, please disallow it. Whatever is not a business expense, please disallow it. Or if it is specifically disallowed, let's say you have made any payment and you have not made the payment up to the due date of ROI, and that particular expense is covered by 43B. 43B covers some of the expenses which are only allowed only when actual payment is made. But if you have not made the payment, then it will not be allowed. So whatever the expenses which are not allowed, please add them back. So second step should be your expenses side. Third step should be your income side. So if you will see any income, let's say by sales is written over here, closing stock is written over here, then we are fine with it. But if there is any income which is written over here, which is not PGBP, let's say dividend is written over here, that is IFRS, we understand. Or interest on debentures is written over here, that is again IFRS. Rent of property is written over here, that is house property, or any other capital gain thing which is written over there. So please just subtract it, because you are only concerned with your PGBP income. So third step should be your income side. If you see any of the income which is written over there which is not PGBP, just say delete it, just subtract it from your computation. And if there is any income which is exempt income, let's say agriculture income is exempt, share of profit from the partnership firm, share of profit from the partnership firm, it is exempt. So please just delete them. So first step should be net profit, second step should be your expenses side, third step should be your income side. Look at your income. If there is any other income which is not PGBP, just delete that, right? Any expenses which is not allowed, add back, right? Then fourth is your information. Look at your information. So whatever your information is saying, please, you have to proceed it accordingly. This is how you will be computing your PGBP. So this is section 29, how PGBP is computed. Net profit as a P&L account, first step. Add expenses which are debited but which are not allowed. Income side which is credited but it is not PGBP income, just subtract that. And then you will add or less as per your information. Got it? So this is how you will get your PGBP income. Now, the expenses which are allowed under PGBP are from section 30 till 37. From section 30 till 37 are the expenses which are allowed. So let's do it one by one. Section 30. Section 30 is related to the expenses related to building. So if there is a rent of building, repairs of building, rates and taxes of building, or insurance of building. So these buildings should be used only for the purpose of business and profession. If it is not being used for business and profession, then it is not allowed. Actual rent is allowed, notional rent is not allowed. If the assessee is paying the rent to himself, then it is not allowed. If they are paying to any related party, then it's okay. You can pay, but it should not be more than the fair market value. Got it? In excess of fair market value, we will disallow it. but notional rent is not allowed. Rates and taxes of building are allowed subject to 43B. If it is paid up to the due date of ROI, then only it will be allowed. If it is not paid up to the due date of ROI, please don't allow them. So this is section 30 related to building. Section 31 is repairs and insurance of plant and machinery and furniture. So if there is any repair of plant machinery, repair of furniture, it is allowed under section 31 also, right? Repairs and insurance. Then we have section 32, an important section, depreciation. Section 32 says that we will be computing depreciation as per WDV method. Only SLM method is allowed only for power generating unit. Otherwise, for all the assessee, we will be computing depreciation as per WDV method. And we understand what are the rates of depreciation we know in WDV method. See, for building, we have generally building, general rate is 10%, but for residential building, it is 5%. For purely temporary buildings, it is 40%. Generally, it is 10% for building. For plant machinery, the general rate is 15%. But if it is computers, books, etc., books are normal books also, annual publications also, then it would be 40% in that case. Motor car, 15% general rate. But if this motor car is being used in higher business, if you are into this transportation business, higher business, etc., then it would be 30%. Otherwise, on motor vehicles, etc., it would be 15%. Got it? But general rate of plant machinery is 15%. On furniture and fixture, it is furniture and fittings, it is 10%. On intangible assets, except goodwill, you don't have to calculate depreciation on goodwill except goodwill. On other intangible assets, it is 25%. Right? How you will be computing it? Opening WDV. See, let's say this is a block of plant and machinery. Let's say written down value of the block of plant and machinery, it is there 15%. So let's say opening WDV is given to you. Opening WDV of the block, let's say it is 20 lakh. It consists of some 2-3 machines. Opening WDV of the block is 20 lakh. Additions during the year. Additions during the year, let's say 5 lakh. Less money received on sale. Money received on sale or disposal. Let's say you have sold something for rupees, let's say 12 lakh. Right. Now, just first of all, see whether you have the block physically or not. So let's say only some of the machine is sold, only part of the block is sold. So we know that we have the assets available in our block. So physically the block should exist and the value should also exist. So 20 lakh is the opening value. Additions during the year is 5 lakh. Less money received on sale is 12 lakh. So 20 plus 5 minus 12, it is 13 lakh. So this is called WDV at the end for charging depreciation. WDV at the end for charging depreciation. You'll be charging depreciation 13 lakh. First of all, look at it that first of all, some students make a mistake. They charge depreciation on 20 lakh separately, 5 lakh separately. No, you have to charge depreciation only and only on this 13 lakh amount, right? So first of all, you have to ask whether the asset which is acquired during the year, whether it contains that asset or not, whether we have that asset or not. If the answer is yes, generally the answer would be yes, yes, we have that asset. Unless and until we have sold that asset, then we have that asset. So whether you have that 5 lakh rupees of asset or not. So on 5 lakh assets, please compute your depreciation separately. And on the remaining value, how much is the remaining value? On 8 lakh, you have to compute depreciation. So first of all, you have to compute depreciation on this 5 lakh. So 5 lakh, whether you have to ask the question whether it has any asset which is acquired during the year or not. The answer comes yes. 5 lakh rupees is the asset which is acquired and we have this asset. Then second, ask whether it is put to use or not. If it is never put to use, if the question says that it is never put to use, then in that case, we will not charge depreciation on 5 lakh. Only on 8 lakh, we will be charging full depreciation. That's it. If the question says that it is put to use also, but it is acquired during the year and put to use for less than 180 days, then in that case, it would be half depreciation. It could be half depreciation on it. And on 8 lakh, it would be full depreciation. Please don't go and charge depreciation on 20 lakh. Most of the students make this mistake. They charge depreciation on 20 lakh. No, you have to charge depreciation only on 13 lakh. Got it? So this is how you'll be charging your depreciation. And if the assessee is following optional regime, and plus it is mentioned in the question that the assessee is a manufacturing assessee. Plus they have purchased new plant and machinery which is installed in the factory. Got it? All these conditions must be satisfied. So if the assessee is following optional regime, he's a manufacturing assessee, they have purchased or acquired new plant and machinery which is installed in the factory, then there would be additional depreciation also. And how much is the additional depreciation? Of the actual cost, 20% is the additional depreciation, right? Of the actual cost. And if the asset is put to use for less than 180 days, then 10% this year and 10% in the next year. So please remember there's an additional depreciation also. But in default regime, we don't consider this additional depreciation. We give only normal depreciation. Got it? So this is about depreciation, how you'll be computing it. And also remember that half depreciation will be computed if the asset is acquired during this year and used for less than 180 days. Otherwise, if nothing is mentioned about put to use, then we always consider that whenever the asset is purchased, it is put to use on the same date. If nothing is mentioned about put to use date, please always consider the purchase date and put to use date is the same, right? For power generating unit, SLM method is allowed. For power generating unit, SLM method is allowed. What is the rate of depreciation? Question will give it to you, right? You don't have to learn it. Question will give it to you. Although they will not ask you to compute the depreciation, but what they can ask you that if you are computing SLM basis depreciation on any asset for power generating unit, and now the asset is getting sold, then what would be the treatment? See, it's again very easy. So let's say there is an asset which was purchased by power generating unit and they were charging depreciation on SLM basis. And let's say they have purchased an asset originally for 10 lakh rupees and they were charging depreciation on SLM basis. And as of now, in 3 years, let's say they have charged 3 lakh rupees of depreciation already. So now the WDV of this asset is how much? 7 lakh. Got it? 10 minus 3, it is 7 lakh is the WDV. They have already charged 3 lakh rupees of depreciation. Now in the fourth year, they are selling it. So simply make a number line over here and see what is the original cost of the asset. So original cost of the asset was 10 lakh. And how much is the WDV? See, number line is simple. Here, if you will go, the number goes on increasing. Here you will go, the number goes on decreasing. Got it? So let's say the original cost is 10 lakh and the WDV of the asset is right now 7 lakh. And if you are selling it, let's say it is sold for more than 7 lakh. So it is a profit area because the WDV is 7 lakh and you are selling it for more than 7 lakh. So it's a profit area. So if you are selling it more than 7 lakh, it is your PGBP income. So this is your deemed PGBP income under section 41. Although we call it with a special name here for power generating unit, we call it balancing charge also. But the name is not that important, but please remember it would be your PGBP income under section 41, right? And if you are selling it over and above the original cost, that would be your capital gain. It will be your capital gain. So let's say it is sold for 12 lakh rupees. So from 7 till 10, that is 3 lakh would be your PGBP income and 2 lakh would be your capital gain. How 2 lakh is computed? 12 lakh minus 10 lakh. So 2 lakh would be your capital gain. It could be short term also, it could be long term also, depends upon the holding period of that asset. If it is short term, then 12 minus 10, 2 lakh would be your short term capital gain. If it is long term asset, so if it is hold for more than 3 years and now you are selling it. So 12 lakh minus 10 lakh, don't take 10 lakh because you have to index it. So you have to index the 10 lakh rupees of cost also. So whatever is the index cost of acquisition, you have to subtract it. Then you will be getting your long term capital gain. Got it? In case this asset is sold for less than this value, less than 7 lakh, it is a case of loss. So let's say if it is sold for example, 2 lakh. So 5 lakh would be the loss which is allowed under PGBP as a terminal depreciation under section 32 itself. So this is how you will be computing your treatment of sale of power generating asset. Got it? So that this is, I believe it's very easy and now you are able to recall this also. Next, these 33 sections are not in your course. Then we have section 35, scientific research. See, whenever a scientific research expenses are there, if it is outside research, what is outside research? Mainly it is a contribution, it's a donation. We are paying to IIT, we are paying to National Laboratory, we are paying to any approved association or institution. If we are paying to any unapproved institution, then it is not allowed, right? To IITs, National Laboratories, or any approved institutions or association, it is allowed. The day, you just have to see the day when you are making this contribution, whether that was approved or not. Subsequently, if the approval was withdrawn, it will not make any difference because the day when you have contributed the amount, it was approved on that particular day, right? But outside research is allowed only under optional regime. It is not allowed in default regime. Got it? So if in your examination, there is a penal account and it is written that the assessee has made a contribution to IIT for scientific research. So whatever is the amount, let's say 2 lakh rupees, he has made the contribution. If the assessee is following optional regime, then it is allowed. But if the assessee is following default regime, so please add back it will not be allowed. Right? Got it? Please don't make a mistake over there. So outside research is allowed 100%, but only under optional regime, not in default regime. In-house research. In-house research is allowed under both the regimes, whether it is 100% it is allowed, whether it is a revenue expense or it is a capital expense. For capital expense, we never give deduction on land. On land, there is no deduction in under any of the provision of the income tax act, right? Except land, you can allow any of the capital expenditure like building, plant machinery, furniture, etc. 100% deduction would be allowed for scientific research also under both the regimes. Got it? If it is a pre-commencement expenses, so sorry, we can take the pre-commencement expenses also, but maximum of last 3 years. So all capital expenses are allowed before commencement also, except land, obviously. And revenue expenses, see, after commencement, all revenue expenses are allowed for scientific research, but before commencement, not beyond 3 years, up to last 3 years only it can be allowed. But last 3 years expenses of revenue should be only salary or raw material, nothing else, right? After commencement, all revenue expenses, but before commencement, only salary and raw material revenue expenses are allowed. This is called in-house research. And sale of scientific research asset is same as if I've already discussed with you, same like power generating unit. See, there the WDV would be zero. Why zero? Because 100% reduction you would have claimed in section 35. So there would always be a profit area. So from zero till original cost, it would be PGBP income. Over and above original cost, it would be the capital gain. It would be same treatment for scientific research. Then section 35 AD is specified business, 100% deduction. Here it is an investment based deduction where 100% deduction is allowed only on capital expenditures. Revenue expenses, they are normally allowed under section 30 till 37. Revenue expenses are already allowed, but capital expenses now assessee can claim 100% deduction if the assessee is having any of these 14 businesses. So these 14 businesses are called specified businesses. Please remember the 35 AD is only and only available under optional regime. It is not available under default regime, right? So this is only and only under optional regime. So what are, you don't have to remember the dates, but you should know that what are these business: cross-country natural gas pipeline, cold chain facility or cold storage for agriculture produce, warehousing for agriculture produce, 2-star or above category hotel, hospital of 100 beds or more, housing slum redevelopment, housing affordable housing scheme, fertilizer production, inland container depot or custom freight station, beekeeping business, warehousing for sugar storage. If it is warehousing for edible oil, warehousing for any other thing, it is not allowed. Only for agriculture produce it is allowed, and as well as for sugar storage is also allowed, right? Iron ore slurry pipeline, semiconductor wafer fabrication, developing and maintenance of new infrastructure facility. So these are the 14 businesses. So if they are incurring any capital expenditure, 100% deduction is allowed, right? But only under optional regime, it is not allowed under default regime. Got it? If there is any loss under the specified businesses, that can be set off only from any other specified businesses only. So these 14 have a family. If they have any loss, they will take help only from these businesses only. But yes, I'll be telling you in set off, if the normal business has a loss, can that loss can be set off from a specified? Yes, they can help other business, but they will only take help from, if the specified business has a loss, it can only be set off from other specified business only. Got it? Second important point is that if prior to commencement expenses are also allowed, no issues. Second important point is that if you have taken a deduction of 35 AD, if you have taken a deduction of 35 AD on any asset, then you have to promise that for next 8 years you will not be using this asset into your normal business, right? For next 8 years, it should be used only in your specified business. Please do not transfer this into your normal business. And if you will transfer this into your normal business, so whatever the deduction you have taken before the expiry of 8 years, let's say in the 4th, 5th, 6th year, you transfer this into normal. After 8 years, if you will transfer, then there is no issue. But before 8 years, if you will transfer, then what we will do, whatever the deduction which we have given it to you, let's say you have purchased a machinery of 10 lakh rupees, you have taken 100% deduction. But let's say in the 3rd year, you are converting this, or you are transferring this asset into your normal business. So whatever the deduction of 10 lakh rupees we have given it to you, we'll take it back. We'll make it your PGBP income. But when you will be making our PGBP income, we will be giving you the benefit of deemed depreciation, because you would not have claimed the depreciation in those years, right? Because 100% deduction you have claimed, you have not taken depreciation. So for last 2 years, let's say after 2 years, you are transferring into normal business. So for 2 years, we will give you deemed depreciation also. So whatever the deduction you have taken, it will be your PGBP income. But First of all, we will reduce by the deemed depreciation. Got it? I believe that you are able to recall this provision also. So section 3580 deduction minus deemed depreciation. Preliminary expenses, very, very important, and a very minor point it is that, see, majorly in your total income question, when you will be getting preliminary expenses. See, preliminary expenses are allowed. Let's say it is 1 lakh written over here. So what will student do? They say that, sir, we know that preliminary expenses are allowed. Okay, it is allowed. But they are allowed in 5 equal installments. So please don't make this mistake. Preliminary expenses are allowed, but in 5 equal installments. So what you have to do, only 1/5 would be allowed here. Remaining 4/5 will not be allowed in this year. They will be allowed in some other years, next years, but it will not be allowed in this year. So you have to just disallow 4/5 out of it. So 4/5 would be 80,000 here in this case. So only 20,000 would be allowed. 80,000 would not be allowed. 4/5 would not be allowed. Got it? Second thing is that, so one of the method is, one of the type of question is that simply preliminary expenses are mentioned to you. Otherwise, if they will give you more about preliminary expenses, they can also give you that these are the preliminary expenses, and the cost of the project also is given. Cost of the project also is given, and actual preliminary expenses. Then what you have to do is, what is the eligible amount? Actual preliminary expenses or 5% of the cost of the project. Cost of the project they will give you, right? Cost of the project they will give you in examination. So 5% of the cost of the project or actual preliminary expenses, whichever is lower, this is allowed in 5 equal installments. This is allowed. So whichever is lower, first of all, compute whichever is lower, then divided by 5. It is allowed in 5 equal installments, right? Next, it will not come in your examination, but still, if it is a company SSE, we see actual preliminary expenses of 5% of the cost of the project. But in that case, if it is case of company SSE, then first we will see 5% of the cost of the project, 5% of capital employed, whichever is higher. Then we compare it with actual preliminary expenses, whichever is lower. But that is not so important for your examinations. Generally, just remember, whenever the preliminary expenses are there, 1/5 are allowed. More if they will give you the cost of the project. So please remember, only up to the 5% of the cost of the project or actual expenses, whichever is lower. Got it? Okay. 35 double D amalgamation expenses not in your course. VRS expenses, same. VRS expenses, same treatment. In fact, quite easy. Whenever you see VRS expenses in your P&L account, whenever you see VRS expenses in your P&L account, please allow only 1/5. 4/5 will not be allowed, right? 4/5 will not be allowed in here because we understand it is allowed in 5 equal installments. Got it? Okay. Section 36. Section 36 is related to other deductions. Section 36 has a list that these are the deductions which are allowed. So if there is an insurance of stock, insurance of livestock, or health insurance of the employees, these are allowable expenses. So if the business has incurred expenses like insurance on stock, livestock, or health insurance of the employees or their family members, it is allowed. But for health insurance, please remember, if it is paid in cash, it will not be allowed. It should be paid by any mode other than cash, right? Bonus and commission is a allowable expense for a business, but it is subject to 43B. Interest on borrowing. So if you have taken a loan for your business purpose, it's a long-term loan, it's a short-term loan, doesn't matter. So if you have taken a loan for your business profession and there is an interest, that is allowed. But if this loan is taken from any bank, financial institution, etc., then it is allowed subject to 43B. If you have taken a loan from somebody else, then it is allowed on due basis also. But if the loan is taken from bank, financial institution, etc., then it is allowed subject to 43B. Got it? Very, very important adjustment over here. If you have taken a loan for purchase of any asset, if you have taken a loan, and up to the date when the asset is put to use, that interest needs to be capitalized. You cannot claim revenue expenses on that. I believe that you are able to recall this provision also. So let's say if you have taken a loan of 10 lakh rupees, 10 lakh rupees you have taken a loan at a rate of 12%. Let's say on 1/4/23 you have taken a loan and you have put to use your asset on 1st October 23, you have put to use the asset for the first time. So the interest for this 6 months from 1st April till 30th September, it is not allowed under section 36. It should be added in the value of the asset. So you have to claim depreciation on it. So first of all, add back that expense because that is not a revenue expense. So let's say if for the entire year, you were saying that 1,20,000 is the expense. 10 lakh rupees loan you have taken. So let's say 10 lakh rupees loan you have taken at a rate of 12%. per annum. So 1.2 lakh rupees. So here you will see interest on loan 1.2 lakh rupees, right? Now you identified that out of this, 6 months was before the asset was put to use and 6 months was after the asset was put to use. So what you need to do is, if any interest which is related to the period which is before the asset is put to use, let's say it is 60,000 rupees. So first of all, disallow the 60,000 rupees because it is not a revenue expense. It will be added in the value of that asset. And then you have to give the depreciation also on the 60,000 rupees. So let's say it is machine. For example, it is machine. So general rate on machine would be 15% depreciation. So please give depreciation on this 60,000 also, right? And please remember, when you will be giving the depreciation, just see whenever this machine is put to use. If it is put to use for less than 180 days, then it would be half depreciation. It would not be full. I believe that you are able to revise this concept also, right? So interest on borrowing is allowed, capitalized till the asset is put to use. Interest on zero coupon bonds are also not so important for examination, but yes, interest on zero coupon bonds are allowed, but you have to spread it during the life of the bond. Generally calculated in months, divide by the number of months the life of the bond is, you will get the per month interest. And whatever the number of months which is falling in your period, please allow that much interest, right? Employer contribution to statutory provident fund, recognized provident fund is allowed, or pension scheme is also allowed, subject to 43B. So if the employer is contributing to URPF, it is not allowed. To unrecognized provident fund, it is not allowed. But if it is recognized provident fund, statutory provident fund, pension scheme, it is allowed, subject to 43B. It should be deposited up to the due date of ROI. Correct? Second, if it is pension scheme, for pension scheme, there is one more point. It is allowed, but maximum 10%. What maximum 10% of your basic salary plus DA forming part, right? So this is also important. So if you will see in your penal account, there is an employer contribution to pension scheme. So whatever is the amount, it is allowed. But see, if it is not, it should not be more than 10% of your salary, basic salary plus DA forming part. And if it is more, then that excess should be disallowed. Up till 10%, we are going to allow it. Got it? Bad debts is allowed. Actual bad debts written off, it is allowed. If it is provision for bad debts, provision for doubtful debts, that are not allowed, right? Actual bad debts is allowed. Provision for doubtful debts is not allowed. Only for banking companies it is allowed, but it is not in your course. Family planning expenses. If the assessee has incurred family planning expenses are only and only allowed for company assessee. It is not allowed for non-company assessee. So generally you will get the question for individual, right? For individual, maximum HUF, mainly individual. 99.99% individual assessee only. So for individual, if there is any family planning expenses, whether they are revenue expenses, whether they are capital expenses, simply disallow them. Simply disallow them. Family planning expenses incurred by the assessee is not allowed except company assessee. It is allowed only for company assessee. For company assessee, 100% revenue expenses are allowed. Capital expenses are allowed in 5 equal installments. But I'm telling you, in your examination, other than company will come. Mainly individual will come. So please disallow those family expenses, whether revenue or capital. STT or CTT, securities transaction tax or commodities transaction tax, are allowed under PGBP. It is not allowed under capital gain. STT is not allowed under capital gain, but in PGBP it is allowed. That is, if it is your business expense. So if it is your business expense, let's say you are doing intraday trading, that is a speculative business. Intraday trading you are doing. Same day you are purchasing shares, same day you are selling the shares, and you are paying STT. So we understand that that is a speculative business. So there, if you are paying STT, it is allowed as a business expense, but it is not allowed as a capital gain expense. It is not allowed. I'll be telling you this in capital gain chapter also. Okay. So this is section 36. Now section 37, a general deduction. Section 37 simply says that any revenue expense, if it is for business purpose, any revenue expense, if it is for business purpose, it is allowed under section 37, provided it is not covered under section 30 to 36. So mainly I'm telling you, in business, 99% expenses are allowed under section 37, like purchases, like salary, like for example, telephone expenses, advertisement expenses. These all are allowed under section 37. You just have to fulfill the conditions. First of all, there should, because 37 is general. If there is any specific section under section 30 to 36 for any expense, it should be allowed under that particular section only, right? So section 37 says that particular expense should not be covered under 30 to 36, right? Second, it should be revenue in nature. Capital expenses are not allowed under section 37. Third, it should be for business, right? And fourth and important, it should not be prohibited by any law. It should not be an offense. It should be not as a criminal penalty. So if it is in the nature of penalty, if it is in the nature of offense, it is nature in the bribe, etc., prohibited by any law, it will not be allowed in that case, right? So if, see, very important, if there is a GST penalty or a sales tax penalty, right, custom penalty, these are in the nature of contravention of law. These are not allowed. So please remember, any type of penalties are not allowed. But if it is late fees, it is compensatory in nature. If it is late fees, late interest, etc., to GST, etc., it is allowed. So late fees, late filing of return to GST or customs, etc., it is allowed. But penalties under these laws will not be allowed. Of course, any amount of income taxes is not allowed. I am telling in section 40. Income tax is not allowed. Provision for income tax is not allowed. Interest on income tax is not allowed. Income tax is never allowed. But GST customs are allowed, right? If it is tax GST custom, it is allowed subject to 43B. Advertisement expenses are allowed here in 37. But remember, it should not be capital in nature, right? It should not be capital in nature. Second, advertisement in political party brochures, catalog, etc., it is not allowed. It's specifically not allowed. CSR expenses, corporate social responsibility expenses are not allowed, right? Section 38 is simple. Section 38 says that if there is any expense which is partly for business purpose, partly for other purpose, so we will be only allowing only if it is related to business purpose. For other purpose, we are not going to allow it. Then section 40 is small a, very important section. Section 40 small a says that if you are paying interest, royalties, fees for technical services or any other sum which is chargeable to tax outside India. So if you are paying interest outside India, if you are paying royalty outside India, if you are paying fees for technical services outside India, or any other sum which you are paying, and that person is liable to pay tax in India, and if you have not deducted the TDS, you have to deduct the TDS up to the due up during the previous year. So you have two responsibilities. First, deduct the TDS during the previous year plus deposit the TDS up to the due date of ROI. If both these conditions are met, then it is allowed. Otherwise, 100% we are disallowed in this year. In this year, it will 100% will be disallowed if it is outside India, right? And it will be allowed further whenever the TDS would be deposited to the government. It will be allowed in that year. But in this year, we are going to disallow 100%. Second, if you are paying within India, if you are paying any rent, if you are paying any interest to a resident within India, on which TDS was required to be deducted, and you have not deducted the TDS during the previous year or not deposited the TDS during up to the due date of ROI, simply in examination you will get like this, that the interest that the TDS was not deducted on this amount, and the TDS was required to be deducted. In that case, 30% will be disallowed. 30% will be disallowed. When you are required to deduct TDS, generally individual HUF are required to deduct TDS if the turnover of the last year, if the turnover of the last year of the business is more than 1 crore, or of the profession it is more than 50 lakh, then you are required to deduct TDS. And if you have not deducted it, 30% will be disallowed. Got it? Salary payable outside India without TDS, salary payable outside India without TDS, 100% will be disallowed permanently. Even if you will deposit this TDS after, let's say later date also, it will not be allowed. For salary, they will specifically have mentioned it will be permanently be disallowed, right? Not that important. Any income tax, whenever you see in your penal account, whenever you see any income tax, any provision for income tax, any interest on income tax, any late fees filing of income tax, any amount payable to income tax, it is not allowed. But if you are paying to a tax consultant, if you are paying to a chartered accountant, you are paying to a lawyer for income tax purpose, that is a business expense. You are not paying to the income tax department. That is allowed. If you are paying to a CA, if you are paying to a lawyer, etc. But if you are paying to this income tax department, provision for income tax, interest on income tax, penalty for income tax, late fees of income tax is not allowed. Income tax is specifically disallowed, right? Tax paid by employer on non-monetary perquisites, not so important, but it is not allowed. So if the employer is paying tax on non-monetary perquisite on the behalf of the employee, that is also not allowed. Like, this is not that important. Now, first of all, 40A2 expense excess payment. 40A2 says if you are making a payment to your related party, if you are making a payment to a related party, and if it is more than the fair market value, then that excess amount shall not be allowed. That excess amount shall not be allowed. Please remember who is the related party. Mainly for individual, you have to see that who is a related party. See, spouse is a related party. Spouse is a related party. Uh, Brother and sister is a related party. Brother and sister is a related party. If the individual is making a payment to spouse, brother or sister is a related party, or to linear ascendant or descendant. Linear ascendant means parents. If you are making a payment to parents or grandparents, or linear descendant, children or grandchildren, then these are the only people who are related party. So if in your question, the question paper will try to confuse you, that they will say that the assessee has made the payment to sister-in-law. See, sister-in-law is not a related party over here. So it is only spouse, brother, sister, parents, or children. These are the only related party, right? Spouse, sibling means brother, sister, linear ascendant, linear descendant. These are the only related party. If you are making a payment to brother-in-law, to a cousin, to let's say uncle, etc., you can make in excess of fair market value. Also, no issues. To strangers, you can make the payment in excess of fair market value. Also, no issues at all. Correct. So please don't make a mistake over here. So if the payment is made to father-in-law, sister-in-law, brother-in-law, in excess of fair market value, 100% allowed. Please do not disallow anything. But if the payment is made to these people, then it should not be in excess of fair market value. 40A3. 40A3 says, it's again a very, very important section, and I believe that everybody knows it now, that if in one day you are making a cash payment of more than 10,000 rupees to a single party, then it will not be allowed. It will not be allowed. But to a transporter, to a goods transporter, you can make the payment up to 35,000 rupees. To others, maximum 10,000 you can make. More than 10,000, we will disallow fully. If you have made the payment 11,000 completely will be disallowed. To that goods transporter, up to 35,000 is allowed. If you have made the payment 36,000, entire 36,000 will be disallowed. Got it? And there are, so how you should make the payment? You should make the payment through account pay check, account pay bank draft, ECS, debit card, UPI, etc. This is how you should make the payment. Now there are certain exceptions where you can make the payment. You can make the payment to banks or government. You can make the payment for purchase of agriculture produce, forest produce, fish or fish product. From, if you are making a payment direct to the cultivator, directly to the farmer, if you are making the payment, then you can make the payment. If you are making the payment to any vendor, then you cannot make the payment, right? It should, to vendor, if you are making, it should be in by banking mode. But if you are making a payment to the cultivator, then you can make the payment. If you are making a payment which for the products which are made without aid of power to the manufacturer directly, then you can make the payment. But if you are making the payment to any other person, then it should be through banking mode. Payment made in a village when there is no bank. If you are making a payment to any person who doesn't have a bank account, why? Because the place where he resides, generally he does a business, there is no banking facilities available. So you can make the payment to him. You can make the payment to an employee on retirement, maximum to 50,000 rupees. You can make the payment to the authorized dealer for purchase of foreign currency, right? Provision for gratuity. See, if it is approved fund, if it is approved gratuity fund, then it is allowed, right? And if it is unapproved, or even if your question says that we have made a provision as per the actuarial valuation, please don't allow it. Please don't allow it. It should only be if it is approved fund, then only it is allowed. And if it is not approved, then simply we will disallow it, right? Deemed business income. Whenever you will receive bad debts, whenever there are any bad debts which were claimed earlier, but and now you are receiving it in the year of recovery, it will become your PGBP income. Any expense which was debited earlier, now you have recovered it, it will become your PGBP income. Whenever you sell your power generating asset, whenever you sell your scientific research asset, and now it is a deemed PGBP income, we have already covered. This would be covered under section 41. Got it? Section 43B, important. See, these payments, whenever you pay, these payments should be actually made up to the due date of ROI. If you have not made the payment up to the due date of ROI, it will not be allowed. So these payments should be made up to the due date of ROI. So if there is any tax or cess payable to government, this should be paid up to the due date of ROI. If you are making any bonus, commission, or interest to any bank, we have already discussed financial institution, etc., it should be as up to the due date of ROI. Payment of leave salary, payment made to Indian Railways for use of the rail assets, it should be up to the due date of ROI. Then only we will be allowing it. Otherwise, we will be disallowing it. Very, very important. Payment to MSME. If you are making a payment to any micro, small, medium enterprises, then it is allowed on accrual basis only and only if the payment is made within the time period. And what is the quick time period? You have to make the payment as quick as possible. So what is the quick time period? See, if there is a written agreement, if there is a written agreement and you have made the payment as per the written agreement, and maximum the written agreement should be for 45 days only. So if you are making a payment after 45 days, it will not be on accrual basis, right? So if there is a written agreement, it should be made as per the written agreement, maximum 45 days. And if there is no written agreement, it should be made the payment within 15 days, right? If you are making it after 15 days, it will not be allowed on accrual basis. It will be allowed only on payment basis, right? So this is important. 43CA, actually 43CA is same as 50C of capital gain. So we'll be discussing 50C first, and then 43CA you will automatically be understanding it. So 50C will be discussing it. It's real estate transaction. Then, so the next section is section 44AA, maintenance of books of accounts. So you are required to maintain the books of accounts if you satisfy the conditions. First of all, who are required to maintain the books of accounts? We will be dividing our assessee into two groups. One group is notified professionals. In notified professionals, people who are into medical profession, that is doctors, lawyers, engineer, chartered accountant, cost accountant, company secretary, film artist, interior designers. These are the people who are required to maintain the books of accounts, provided that if their gross assets of last 3 years exceeds 1.5 lakh of all the 3 years, they are required to maintain prescribed books of accounts. So what are prescribed books of accounts? Cash book, general ledger. These are the prescribed books of accounts. Bills issued by them. Bills issued by them if the value of the bill is more than 25 rupees, and the bills which are received by them, if the value of that bill is more than 50 rupees, then they are required to maintain these documents also. And also if the person is a doctor, that is into medical professional, daily case register and the inventory of the medicine should also be maintained. These are the notified professionals. Now, the second group is businesses or other professionals. So the person who are carrying business or other professional, if they are not having their income or their turnover is not that much, they are not required to maintain the books of accounts. But if their income exceeds a certain limit or their turnover exceeds a certain limit, they are required to maintain the books of accounts. So if they are individual or HUF, their income exceeds 2.5 lakh rupees. For individual or HUF, 2.5 lakh rupees income. For others, it is 1.2 lakh income, right? So for individual or HUF, if the income exceeds 2.5 lakh of any of the last 3 years, got it? Any of the last 3 years, then they are required to maintain the books of accounts. If their income is not exceeding of any of the 3 years, then you can see the turnover also. If their turnover is 25 lakh rupees, if their turnover is 25 lakh, is more than 25 lakh rupees of any of the last 3 previous years, then they are required to maintain the books of accounts. If the person is individual or HUF, remember income 2.5 lakh, turnover 25 lakh. For others, if the person is not individual or HUF, for others, it is income 1.2 lakh and turnover 10 lakh rupees. Got it? And person who are opting for presumptive income 44AD, 44A, 44ADA, they are not required to maintain the books of accounts. But if they are claiming that their income is less than the presumptive income, then they are also supposed to maintain the books of accounts. Got it? 44AB, tax audit, a very, very important section. This section says that if they are dividing this into two groups, one is all professionals, not notified, all professionals in one group and businesses in other group. First, I'll be talking about the professionals. If the professional gross receipts, that is the turnover, if the gross receipts of the previous year 23-24, if it exceeds 50 lakh rupees, they are required to get their accounts audited. So assessee carrying profession, if their gross assets exceed 50 lakh rupees, they are required to get their accounts audited. For businesses, the turnover limit is 1 crore rupees. So if the business turnover is more than 1 crore, they are required to get their accounts audited. But we are giving a relaxation to some businesses up to 10 crore rupees. If their turnover is up to 10 crore rupees, they are not required to maintain the books of accounts, provided they have transparent transactions. What is transparent transactions? Whatever the receipts which they have made, whatever the payment which they have made, whatever the receipts they have taken, the payment they have made, it is not exceeding 5%. Then all their cash transactions, cash receipts, cash payment, of the total payments or total receipts, if it is up to 5%, then we will give them a turnover of 10 crore. Up to 10 crore, they are not required to get their accounts audited. But if it is more than 10 crore, they are required to get their accounts audited. But if their cash transactions are more than 5%, then the limit would not be 10 crore, it would be 1 crore only. Got it? Now, presumptive scheme 44 AD, 44 ADA, and 44 A. 44 B, double B, A, etc. is not in CA intermediate course. So we have only three sections: 44 AD, 44 ADA, and 44 A. Section 44 AD, presumptive income. Here, if the assessee's turnover is up to 2 crores, then they are eligible for presumptive scheme. And how much is the presumptive income? 8% of their turnover. 8% of their turnover. But if the turnover is received in through banking mode up to the due date of ROI, we will be taking 6%. So please remember 6% or 8%, right? So their presumptive income would be 8% of the turnover, but 6% in case of banking transaction if the turnover is received up to the due date of ROI, right? If their gross receipt is up to 2 crores. But now there is little amendment also. Now we can give them presumptive scheme even if their turnover is up to 3 crores also. But if your turnover is more than 2 crores up to 3 crores, then we will see how much is your total out of total turnover, how much is your cash turnover. If your cash turnover limit is just up to 5%, then you are eligible for 44 AD. But if your cash turnover out of your total turnover, let's say somebody's total turnover is 2.5 crores, just see how much is the cash turnover percentage. If this percentage is up to 5%, this person is eligible. But if this percentage is more than 5%, this person is not eligible. Got it? So this is important. Who are eligible? Resident individual, resident HUF, resident partnership firm are eligible over here, but not LLP. Not any other SSE, only individual HUF or partnership firm who are resident, and in firm, LLP is not eligible, right? Person who are carrying notified profession, person who are carrying goods transport vehicles business, they are not eligible in 44 AD because we have a specific section of 44 ADA and 44 AE for them. What is 44 ADA? This is for notified professionals, the notified professionals which are mentioned in 44 AA. Chartered accountant, cost accountant, company secretary, doctors, engineers, lawyer, film artists, etc. They are eligible for 44 ADA if their gross receipts during the previous year is not more than 50 lakh rupees. It's not more than 50 lakh rupees, they are eligible. And how much would be the presumptive income? 50% of the gross receipts. So let's say if their gross receipts is 45 lakh, so their presumptive income would be 45 lakh into 50%, right? Now there is a little amendment also. For some people, if the gross receipts is exceeding 50 lakh, but up to 75 lakh also, they are also eligible. The same thing is their cash receipts out of the total receipts should not be more than 5%. Then also they are eligible, right? Next presumptive income is 44 AE. The person who are into the business of goods garage vehicle. And if this person does not have more than 10 goods garage vehicle at any time during the previous year, they are eligible. How much would be the presumptive income? If it is a light goods vehicle, medium goods vehicle, the presumptive income is 7,500 per month per vehicle. 7,500 per month per vehicle. But if it is a heavy goods vehicle, now what is a heavy good vehicle? The weight of that vehicle, if it is more than 12,000 kg, that is 12 tons. If it is more than 12 tons, that vehicle is known as a heavy goods vehicle. And for heavy goods vehicle, the presumptive income would be 1,000 for every ton. So let's say the vehicle weight is 13 tons, then the presumptive income would be 13,000 per month for that vehicle. If the vehicle weight is 15 tons, the presumptive income would be 15,000 per month. Got it? So this is very important. 44 AD, 44 ADA, and 44 AE. You should know what is the percentage of presumptive income, right? 44 BBA is not in CA intermediate course. Okay. One of the important thing is about agriculture income. About agriculture income, this is an important concept, that how much would be if the person is carrying composite business, then how much would be the agriculture income, how much would be the non-agriculture income. So please remember, if the person is carrying rubber business, coffee business, and tea business, we have a specified percentage. For tea business, it is 40%, 60%. For rubber business, it is 35 and 65. And please remember, the majority is going towards agriculture. The majority is going towards agriculture. See, 40, 60. What is the majority? 60. 60 is going towards agriculture. For tea, 40, 60, rubber 35, 65. For coffee, if you are just growing and curing coffee, then in that case 25%, 75%. If you are growing, curing, roasted and grounding the coffee, then 40%, 60%. So this is an important portion, right? So this was about the agriculture income. You should know about the agriculture income also. Nursery plantation business is also 100% agriculture. Whenever you get rent from any property or any land which is used for agriculture purpose, that is also 100% agriculture income. But if the agriculture income is coming from outside India, then it is not exempt. It is taxable under IFOS. Got it? Okay. Next chapter is capital gain. So let us start with the next chapter in our next part of this video, right?